Good morning to our wonderful audience, and thank you for joining the second day of the Offshore Investment Managers webinar. It's great to have you all with us again, and thank you for your continued support. If we look at what happened over the past week, markets were up on Friday as Fed Chair Jerome Powell signals monetary policy could ease in September. But did he make a mistake in going down the unemployment mandate or not, and not the inflation one? Markets remain wary and volatile as they wait for more data on inflation to be released running up to the September announcement. We're going to jump right into it. We've got a jam-packed agenda with some of the top fund managers across the globe. For our first session this morning, we will have a look at global credit and if credit spreads are trading now, or where they're trading, and if it offers investors opportunity. It's my pleasure to welcome our first presenter, part of the Fairtree Global Fixed Income team in London, Dane Merrick. Good morning, Dane. How are you?
Morning, Eugene. Very good, thanks.
Fantastic. Dane, thank you so much for coming onto the session this morning. A little bit early your side, so
No
thank
problem.
you very much
thanks
for
having
that.
me.
Great stuff. We're ready for you if you are.
Sure. So, as mentioned, I'll be taking a look at global credit. My name is Dane Merrick. I'm a fund manager and quantitative analyst working for Fairtree Asset Management. Our team is based both in London and in Newlands, and I'm in the London office. So, what will I be going through? I'll be taking a look at our main global credit fund, a bit of a background on that. I'll take a look at the benchmark that fund follows. It's not an index track, it's an actively managed fund, but we will take a deep dive into the index. Take a look at where credit spreads are trading at the moment, what we can infer from these spreads based on historic returns. We'll see how the current market has impacted our current positioning. And then to end off, I'll just look at the boogeyman of credit, everyone's favorite defaults. So I think sometimes they get a little bit too much attention, but we'll take a look why I say that, and then we'll just end up with a conclusion. Starting with the fund and the benchmark. So our team, it manages 10 long-only credit mandates. One of them in particular is a global focused credit fund. This fund aims to generate a high level of current income via investment in primarily credit instruments. I haven't actually put it yet, but the fund's name is the Fairtree Global Flexible Income Plus Fund. It's benchmarked against the iTraxx Crossover Total Return Index. This is a high yield credit index based in Europe, and we'll be taking a deep dive on the next slide. The fund started in January 2019, so it has over a 6-year track record, and it's managed by Paul Crawford and myself. I think most of you will probably be aware of Paul. He's spoken a few of these meetings before, and he is our main fund manager across our fund suite and our team lead. Some further details about the fund. It's a euro-denominated Irish domiciled UCITS style fund. UCITS limits credit concentration risk using the 5-10-40 rule. I won't go into the details of this rule now, but the long story short is that this is a more stringent and strict limit on credit than BN90 that is used in South Africa. The fund invests predominantly in euro assets, but does also include some pound and some USD assets. Whenever we do get offshore assets or any interest rate risk or duration risk in the form of fixed coupon bonds or zero coupons, we hedge both the FX and or the interest rate away using listed futures. This is done to ensure that the primary risk characteristics of the fund remains credit and credit priced in euros. Income for the fund is generated by spread capture. What this means is the credit instruments that we invest in produce a credit spread. This is superimposed on the European cash rate, Euribor, and this produces a final yield and income for the investor. I've listed the fund's Bloomberg code there if you want to do more research, and the fund is classed as a global bond UCITS. Assisting Paul and myself in the management of this fund, we have a very stable investment team, a core team of 6 members. The 2 most senior members, Paul and Louis Anselm, they've been working together for over 20 years now. 5 of us have been working together for almost a decade, and then our newest member joined us from academia at the beginning of this year as a junior quant analyst. Let's take a deep dive into the index. So iTraxx Crossover Total Return, it's made up of 75 equally weighted liquid global sub-investment grade credit default swaps. It's reconstituted twice a year, once in March, once in September. So we're having a new series issued next month. Each series has a few tenors. There's a 3-year, 7-year, 10-year, but we focus on the most liquidly traded point, which is the 5-year. Currently on series 43, series 44 next month, and then series 1 started back in 2004 and the 5-year matured in 2009. Rules for inclusion in the index. The index limits itself to corporate credit default swaps, so sovereign CDSs are not permitted. Each CDS that is permitted for inclusion index must have a sub-investment grade credit rating, and the CDSs with the highest liquidity measured by recent trading volume are included in the index. This index, it possesses all the characteristics of a high-quality benchmark. It's specified in advance. A return is easily measured. It's unambiguous, and should you so desire, it's fully investable and replicable. As mentioned, we are actively managed across all of our funds, so we don't do any full replication, but it is possible should someone desire. Let's take a look at some market observations. We'll start off with credit spreads. I've shown long-term credit spreads of the index here, the iTraxx crossover, starting in 2004. So this is over 20 years record. The red line is the long-term average for the spreads, and that's sitting at 378 basis points, and we're currently trading at 261. This year has felt a bit strange for me from a fund manager perspective. It's felt, I would say, unusually and extraordinarily uncertain and turbulent with everything that's going on globally. But this doesn't seem to be coming through in credit spreads. We saw a very small kick up in spreads early in the year, and we did use that as an opportunity to put on some additional risk trades when spreads were a little bit higher. But currently we're trading at historically low spreads, which I feel is a bit of a mismatch given the environment that we're in. Looking at the graph, it might be easy to think that average is skewed upwards due to the global financial crisis, and then in the early 2010s, the European sovereign debt crisis. So let's just take a look at 10 years to see if things change. The average does come down a little bit. It drops to 324, but you're still seeing that we're meaningfully trading below longer term averages. Even if we looked at a shorter term, it would be even more extreme with the spikes during the COVID era. So let's take a look at this data in another format. What I've done here is I've looked at weekly data throughout the lifetime of the index. I've bucketed into 25 basis points buckets, and I've shown where the highest concentration of spreads have historically been. So you can see in that 250 basis points to about 350 basis points range, we're having our highest concentration or our highest frequency of traded spreads. We then do also have this long right-hand tail capping at about 1,150 basis points. And then on the downside, we floored at roughly 200 basis points. So looking at that current traded spread of 261, you can see how low we are, in fact, trading at the 20th percentile compared to historic levels. More important than this, where we're trading, is how is this related to future returns? We can see actually a surprisingly linear relationship between the current spreads and then subsequent future returns. As that spread increases, you're seeing an increase in future returns. And unfortunately, in that 200 to 275 range, we're actually seeing slightly negative to flat returns. This has quite heavily impacted our current positioning in the fund and how we've structured the fund, and we'll come to that in the next section. Quick look at risk. Risk surprisingly stable across all buckets. This is measured by the standard deviation of returns. We're looking generally between 9 and 11% standard deviations, but there does seem to be a sweet spot for risk between about 300 and 350 basis points. When we're looking to add risk, at 350 basis points is a really nice number, because you're starting to see that kick up of returns, but also that slightly lower risk that helps your Sharpe ratios. We have a new series starting next month, as mentioned. So what I've plotted here is on the x-axis, I've taken a look at all previous iTraxx crossover series, their spreads at their inception. And then on the y-axis, I've taken a look at their subsequent cumulative excess returns. There are a couple of takeaways here. The first takeaway is that none of the previous series that have concluded have ever had a negative excess return. So this shows that you've always been adequately compensated for the credit risk that you've incurred. The second takeaway, indicated by that green or olive line, that's where the spread is currently trading, is you can see how close to the lowest spread this new series is likely to be issued at. How do these market observations impact our current positioning? Well, as mentioned, 2025 has been an uncertain time for global markets, but despite this, credit spreads are trading near some of their near their lows at the 20th percentile. Series 44 inception is next month, and credit spreads are as close to as low as they've ever been at the start of a new series. This has historically led to positive excess returns, but the returns have been very small. To represent our views of these low spreads, the fund is quite defensive at the moment. We're holding a large proportion of cash, 12%, and we will look to deploy this cash gradually if spreads maintain their low levels. The reason we deploy the cash gradually and systematically is to ensure that the credit spread and therefore the yield of the fund is comparable to that of the benchmark. If we see spreads kick up, we will look to deploy that capital a little bit faster. As mentioned, 350 basis points is quite an attractive point where we start to put on the risk at a little bit of a higher rate. Despite the high levels of cash that we're holding, we still are out. Our weighted average spread is higher than the benchmark. We're sitting at 327 basis points versus the benchmark at 261. So despite having the defensive risk position, we still are getting that spread and that yield that is comparable to the index. Our defensive position really comes through in our spread duration. We're sitting with a spread duration of 2.75 versus the benchmark's 4.59. What this means is that if we do see a kick up or an increase in yield and credit spreads, we will lose less than the benchmark. Conversely, if spreads rally, we will gain less than the benchmark. But we are quite close to historically low levels. So we are comfortable with this current position. Onto something slightly different here. Let's take a look at the impact of defaults. I think defaults are largely considered the bogeyman of credit investing. I think investors give them a lot of attention. For me, I just consider them another part of credit investing, and it's obviously where we're getting a lot of our excess returns and our compensation from. They're also not as frightening as they might seem at first glance. Jump to default is a rare occurrence. What this means is that companies and sovereigns don't often default out of the blue. Generally, over time, we can see the quality of the entity degrading. This is then represented in the spreads. And by the time that the default actually occurs, the losses have almost already been priced and have come through in return series. Even then, once default does occur, there is still potential for some level of recovery from the auction process. In the next two slides, I've actually laid out some experiments looking at break-even default points in the iTraxx crossover, and we'll get into that next. As I said, historically, investors have always been well compensated for taking on credit risk, and defaults are just a normal part of investing in credit. So I can see I'm running a bit short of time, so I'll just jump through these experiments. But this is what I've set up here is, I would say, a worst case scenario experiment with regards to defaults. I've looked at all the past iTraxx series, the ones in gray on the right hand side. Those haven't concluded yet, so the realized defaults may still increase. The blue line is the break-even default point. How many defaults do you need to have in this worst case scenario world, which is defined as a 0% recovery? Not realistic based on what we've seen in the past, but how many defaults would you have to start getting negative excess returns and to lose money versus the cash rate? So we can see that even in this worst case scenario world, there are only two series where there was sufficient defaults to have triggered or have exceeded that break-even point. We know that excess returns were still positive, and that indicates that in those series, we did have non-zero recoveries. Moving on to a slightly more realistic example, this is looking at defaults in a world where you have a 40% recovery rate. This is still even quite conservative. It's more realistic, but still conservative. Generally, you're going to see recoveries historically around 50 to 60% mark. Here you can see how comfortably the series have traded within those break-even points. Quick conclusion of what we've gone through. Our global credit fund aims to generate a high level of current income via investment in credit instruments. It's benchmarked against the iTraxx crossover, which is a European high yield credit index. Current spreads are unfortunately as close to the lowest the benchmark has seen in its 21-year history, trading at the 20th percentile. When we looked at subsequent returns from these low spreads, we saw that they were slightly negative to flat. This is somewhat disappointing given the global environment that we found ourselves in this year, and it feels like we're not being sufficiently compensated at this point for the volatility on the go. Because of this, we hold a defensive position in the fund. We hold a comfortable cash balance, 12%, and we maintain a relatively defensive spread duration relative to the benchmark. That being said, the weighted average spread of the fund is still superseding the benchmark. And then to end off, defaults. Hopefully I've convinced you that they're not necessarily the bogeyman that everyone might initially assume them to be. Thank you very much.
Dane, thank you very much for that. Insightful indeed. And I mean, we're all very much aware of how Fairtree managed defaults exceptionally well over the past 15 years. I mean, you've got a phenomenal track record. So I don't think that's the real boogeyman, not within your team, because it's something you're very thoughtful of. Maybe just quickly, and maybe just to reiterate that, because I mean, if you look at global credit, there seems to be a lot of focus on US credit, but this fund addresses something very different because US credit spreads are very thin, very narrow, and people say stay away. But there's focus on European credit. So that's a main component in your fund. And I mean, you spoke about the credit spreads that you've got and some of the opportunities that you may take. Just from an SA investor perspective, I'm just trying to understand how and where we use this fund. So this would typically be for a global investor, and help me right, and where do you see this fit in? And somebody's saying, but I don't want everything in equity or property necessarily, and I want some more defensive assets, and cash are maybe just not doing it. Would they then look towards the Fairtree Global Income Plus Fund as an alternative to a cash holding?
Yes, I mean, I think when we've seen those excess returns over cash, I think you can see the value add. I mean, the value add versus cash is very easy to show. And I think for a global portfolio where we've got a mixture of assets, I think credit is often underlooked. It correlates well with other assets, and I think it can add good value. We do also have alternative vehicles to invest in the credit. So we have some local funds. We have a feeder fund for this fund, and we have some local funds that also get exposure to offshore credit, either via investment directly in this fund or direct investment in offshore assets.
100% right. And you mentioned exactly that. And there's a question from the audience addressing that. So you've got the foreign denominated version on a BCI platform. We've got the Fairtree BCI Global Income Plus Fund, which is a feeder fund. And part of it fund also features in the Fairtree Income Plus, which you're all familiar with. So the global component actually feeds partly into your holdings that you just showed. Now, Dane, thank you so much for your time this morning. Always great to have Fairtree on board, and always good to consider as part of a client's portfolio, as I just explained now. Thank you so much.
Pleasure. Thank you very much, Eugene.
Fantastic. And we're moving on to King's Global Index Funds or index investing, getting good global exposure at very low costs. And always a pleasure to welcome Anthony Ginsberg, Managing Director at King's Global. Anthony, good evening. It's not good morning for you. It's almost pumpkin time where you are. You stayed awake all day already just for our session. Thank you so much. Really great to have you. Late evening for you, and very grateful for your time.
All right, thank you, Eugene. It's always a pleasure to join you, especially after a Springbok rugby victory, and also the markets have had a good trot over here. So happy to talk about three key things, really. One is we'll get onto the US outlook with President Trump. There's always fun and games, but there's been a real broadening out of the market depth here, which is very positive. You know, often the Dow, the S&P gets all the news, but actually there's been a very significant broadening out of those stocks, including small caps and mid caps represented by the Russell 2000. So it's actually been a very positive broadening we've seen here. And the other 2 points I want to cover is obviously our BCI fund, the MSCI World Global Equity Index, and we're very grateful, Eugene, to you and your team, Tanya, Olga, and Robert, and obviously many people on this call for all the support. So it's approaching 2 billion Rand, the fund at the moment. And then the last point I'll touch on is also this indexing revolution that we continue to live through. And it's been going on for the last, let's say, 15 years, and I'll try to touch on a few of those. So let's move on to the next slide. I think there's supposed to be a poll that's going to also come up in a moment. This is just a little bit of background about Gins Global. We're in about 8 different countries. We cover ETFs, index funds, as well as index-linked notes and insurance annuities, which increasingly in the US are also tied to indexation. It's all part of the indexing revolution. Just as an example, almost $150 billion a year goes into index annuities in this country. So hopefully you guys can just complete this brief poll. It talks about, it's a quick question, what percentage of US fund managers have actually outperformed the S&P 500 over the past 10 years? And we gave 4 choices there: 50%, 40%, 25%, or 16%. This is over the last 10 years. So we'll just wait a moment or two for the response, and then it may surprise you what the answer is. But the outlook here in the US as we wait is actually fairly positive. You've obviously heard about Chairman Powell, and we'll touch on the fact that it's very, very likely, there's a 90% chance now that the Fed will likely cut. It's basically just after the first week in September, after Labor Day here. And you have to, when you look around, the unemployment rate remains low, but the amount of hiring has not picked up dramatically. And Eugene, as you touched on, there's a sense of wanting to lower rates, particularly because the real estate market and the consumer spending has been somewhat depressed. And if we can get mortgage rates below 6% here, that is seen as a success. So it looks like you've got a very knowledgeable audience, Eugene, very impressive, because the vast majority, 56%, voted correctly that only 16% of active US fund managers have actually outperformed the S&P over the last 10 years. So congrats to all those who voted for number 4. I'll just move on, and just to summarize, we've also got some patented index products also in the States. A lot of it relates to work we've done with Citibank, AIG, and Zurich Life, where we have this hindsight index. And I'll also cover the tech space, because amongst the top performers, we all know about AI, but there are a few less heralded areas within the tech megatrend space. It's an ETF we actually run out of the London Stock Exchange, and it's also part, obviously, of the MSCI World, so it's an important component. So we'll just move through a couple of slides, and I'm happy to, of course, take questions as well. Just to summarize, on the facts and figures of the MSCI World, everybody has heard of it, but there's some interesting surprises, perhaps I can just show you in terms of facts and figures. Our TER on this BCI fund is 33 basis points. The TIC is 37 for the feeder fund. And we're using State Street for a variety of reasons. We've used them for almost a quarter of a century. Not only are they one of the top 3 asset managers globally with over actually 3.5 trillion of assets, but because they've got offices in about 20 countries, they actually allow us to, in some cases, almost outperform the underlying benchmark because of the tax withholding benefits we get using State Street. And what that refers to very quickly is the index designers, MSCI, when they do it, they're assuming maximum dividend withholding taxes across the US, Europe, and other countries. And if you're actually deploying tax treaties effectively, as State Street do, it actually boosts your basically your after-tax gains. So there's a strong reason why we've gone with such an index leader. And of course, the 1,600 developed market shares across 23 countries. It's really used, Eugene, as a low-cost call. And again, we believe in blended portfolios, both active and passive. There's room for everybody. I'm just going to take you through the index revolution that's occurred briefly here, and also just the fund. So we'll move on to the next couple of slides. And this just shows if you had $100 sitting 15 years ago in the MSCI world, it would have grown to $516. That's the purple line. By comparison, the all-country world, which includes emerging markets and developing markets as well, that would have only produced $460. And the drag for the real reason there is that the US has a larger weighting in MSCI world. And I have a slide coming up. The last point there is you can see emerging markets have been a real laggard. They finally are picking up, as we've seen this year. And we had a nice run. But you can see over 15 years, really, MSCI emerging markets has been rather flat as a pancake by comparison. So MSCI World gets the benefit of the US tailwind, and that's why it's been the best of the three. We'll move on to a slide that just sort of summarizes what would have happened, that your analyzed return, that's a cumulative number you just saw, but the annualized numbers are quite impressive. Over 10 years, it's 10.6% annualized in dollar terms, the MSCI World. That means basically $100 in 2015 would be worth $270 today as of the end of July. And if we go back all the way pre the 2000 bubble, 2001 bubble, we still get a 7% annualized gain since 1998, meaning $100 would have grown to 580 now. So that's the reason why the pension funds in America, the large institutions, are significant buyers of indexation on the core, both on the US domestic S&P 500 benchmark, but also on the global MSCI world. We'll move on to a slide that really shows the differential. If you had actually excluded the US, you can just see how much lower your gains would have been. And going back many, many years, I've worked for firms in Europe and elsewhere that continually sort of underweighted the US, which is MSCI there in blue. And you do ignore America at your peril, quite frankly, because it's had significant gains. And it's not just tech-driven. It's across the board. We can go back, as you see, to 2015, 2020 even, and see some of the recovery. Part of it is AI-driven, but it's significantly broader than that. We'll go to the next slide and try and just give you a shock maybe that when we were first looking at MSCI World years ago, I'm going back a quarter of a century, it was around 50-odd% of the country weights. And it's grown significantly. It just shows you how dominant the United States currently is. So the weightings currently surprise many. It's 73% for the US. Japan is second at just over 5%. The UK at 3.4%. And then you get a smattering of Canada, France, and all the other countries of the 23 put together are 12.4 in the green pie there. Thanks. We'll go on to perhaps a very interesting slide, which is the revolution that's occurred, particularly in the US, but it's spreading globally, where over the last 10 years, if you look at cumulative flows out of active fund managers in green and into the blue of passive or index managers, primarily mutual funds, index funds, and now also ETFs, you can obviously see it's been a significant revolution away from active into passive. The next slide has a similar story. It's just shown a different way, where you see outflows out of active fund managers. And again, we're not dismissing the benefits of active. We're just saying that there's a reason for this blended approach that has really grown significantly. The following slide, if you can put it up, will show you, rather than just the outflows of active, you'll see actually the revolution there in green. Since basically 2011 through to 2023, in green, you can see the significant growth in passive and indexed assets, and essentially overtook, by March 2023, it had overtaken active assets. And today, that green number is closer to $15 trillion, and in the green, and the orange has sort of flatlined, as you saw from the previous two slides. So this just encapsulates, and there's a very good book called Trillions, which I recommend, on this revolution that we all have essentially been living through for the last decade and a half. and we'll move on to one or two other interesting slides I think you hopefully will appreciate. In America, we've seen up to 70% of funds being merged out of existence within every 10 years or so. So this whole story of the stock pickers market, yes, there's a minority certainly of top active managers, but there really is a myth that the majority of stock pickers are able to perform well. And most of it comes down to their significantly higher costs. So indexing, as we all know, has a much lower cost and a lower hurdle rate, and that gives us, you could argue, an unfair advantage against some of our friendly active managers that we go up against. Ultimately, indexing is a diversified strategy. It's not just low cost, but it gives you the exploration of covering pretty much the global audience. MSCI World, incidentally, is 85% of the market cap of each one of these 23 countries I was referring to. So you're essentially covering the main market cap and the main part of 23 developed nations. If our clients typically want to do a separate access or core for emerging or for developing nations, and they buy a separate building block for that. But most pension funds and institutional fund managers in the States typically will have a developed core, and this is why we've gone with the MSCI World. I'll move on to the next couple of tables, which just show the outperformance relative to US fund managers. US fund managers have really struggled. They've actually been beaten hands down over 5 and 10 years. I'll just, for the limited time we have, if you focus on the yellow column there, for large caps, mid caps, small caps, it's generally around 80 to 85% of US fund managers losing out essentially to the S&P 500, the S&P mid cap and small caps as well. The bottom row there is the overall market, which we call the S&P 1500 here actually. And that's almost 90% of US fund managers being beaten essentially by the benchmark, sadly. And again, I've said this to you before, Eugene, and to your audience, perhaps in the 60s and 70s, folks like Peter Lynch, could find, unheard of diamonds out there. And frankly, there was also a lot going on the golf courses here. I'm a member of a country club here in LA, and I can tell you, people have to be very careful what they say. If they're a CEO of a public company, it's not the most fun position necessarily, because they've really got to watch every word, and that's why these earnings calls have become essentially now the main way of transmitting data, which was very, very different in the old days when analysts may have had a far closer relationship outside of quarterly calls. So it's far more difficult, one could argue, with AI and also just with all the analysts that are out there today versus the 50s, 60s, and 70s to outperform. It's become very, very difficult. I'll move on to one or two other slides, which just show Morningstar's latest numbers. The past 12 months, Morningstar showed 33% only of US fund managers beating the broad set of equity indices. And if you break it down further, it's about 32% beat large caps, 30% small caps. Managers won their races, and about only 28% of mid-cap managers. So you could argue it's an expensive gamble going for some of these American and even European active managers. But ultimately, a blended approach seems to work best, and that is the way we've seen most large institutions operate in the States, including most of our clients and many of the insurance groups we work with as well. I'll just go on to a few more slides and take some questions. We've got one or two other slides, hopefully. This just shows you on the global front how American managers also have singularly failed. If you look at MSCI World, or in America, they often use the S&P World Index here as well as a benchmark over 10 years. Sadly, 90% of the American fund managers, again, have underperformed. This is if you include the global, the US and the globe. The second row is actually excluding the US. And even there, they've had a very, very tough time outperforming. So we'll just move on to a few last slides. This is about the US outlook. And obviously, President Trump, they're always fun and games with him, and he can be very entertaining and quite infuriating. And I know he's not everybody's cup of tea, clearly, of course, in South Africa with the sad 30% tariffs, which is not ideal at all. And hopefully they can be reversed at some stage. But just to talk about the US earnings, they have been very impressive. And there's been this broadening out of earnings beyond just the the Palantirs and NVIDIAs and others that are getting all the headlines. We've got an NVIDIA report coming out in the next couple of hours here. Most expect them to actually beat the earnings numbers again, because, as you know, President Trump has allowed them now to export many of their more advanced chips again to China. But the main point really to focus on is the broadening out beyond the record highs of the S&P and the Dow that we've just experienced, which gets a lot of headlines. The Russell 2000, which is a small cap index, has actually had a huge run. In fact, it's actually the last 5 to 6 days it had the most outperformance versus the Dow and the S&P. But something to just focus on is that the Dow, it only hit its first record high this year last week, whereas the S&P's already had about 18 record highs. So the Dow is actually, interestingly enough, because of the way it's comprised, is actually more symbolic of financials, industrials, some real estate. And when you see the Dow also hitting highs, that shows you this broadening beyond just the tech story. We don't believe there's actually a tech bubble per se, and I'll get to that in a moment. And also, there's no US recession. You certainly don't feel it here at the restaurants, at the airports. We've just come out of a very busy tourist season in the States. And there's also been an M&A, mergers and acquisitions, pickup here since Trump is seen as business friendly, and he's directed the Federal Trade Commission and the SEC to essentially scale back some of their antitrust rules or limitations. So you'll see, I think, more M&A activity over the next 12 to 18 months, particularly in the tech space, who are blocked under the Biden administration. And last but not least, the big, beautiful bill that Trump has spoken about, it does in fact lower taxes on certain businesses and high net worth individuals, and that should spur more positivity. So at the moment, we see the bull market continuing here. We don't see a reason to be that nervous. I'll just move on. The tariff impact has also been constrained. It's been limited. There obviously was this worry with the Liberation Day back in April, but we've had a very, very strong rebound. I'm just going to go to the last 1 or 2 slides, and we're going to touch on the fact that the forward PEs on the S&P 500 are actually lower than many realize when you exclude the Mag 7 or the FANGs, essentially the big tech mega caps. So that's why this broadening out of the other 493 in the S&P is helping our MSCI World, because essentially our MSCI World for the US covers 85% of the American market cap. And we expect that to continue. And it's essentially, these narrow gains were worrying last year, but it's great to see that the broader, cheaper market is actually now finally getting a boost. Just remember that the big tech has a massive cash haul. They are not surprising just in terms of returns. If you look at our tech megatrend ETF, it just shows you that digital entertainment has been number one, not AI. Digital entertainment is actually up 28% year to date as a theme, versus cloud and cybersecurity are both up about 15%. Blockchain, which Trump has also backed now as part of his crypto focus friendly area, has actually also jumped up. So blockchain as a theme is up about 10%. And AI is only up sort of single digits. So it's not true to say that it's all based on AI and that we're in some sort of a bubble. You don't get that sense. In America, if rates start coming down in early September, I think you'll see the real estate market and consumer spending also have an uplift. So these are all, basically boosts or trade wins that are benefiting the US. One last thing is the weaker dollar, believe it or not, is also a boost for MSCI World. Because of the weaker dollar, you find that the earnings, when they brought back into the States, it generally has a significant boost. So a 10% reduction in the dollar is not actually a bad thing for US stocks. Eugene, I think I'll leave it there. There may be one last slide, which perhaps we could just look at on earnings, because people do ask. And it's basically normalized. At the right-hand side in green, you'll just see how earnings are basically about double digits year on year. And obviously the big spikes were after COVID. And the very last slide may interest your viewers because of recession talk. There was a lot of recession talk back in April, May on earnings calls, and it's dropped significantly. So the latest earnings calls for the second quarter in July, August had only about 50 odd companies mentioning recession, whereas you had almost 400 plus back in April, May. I'll turn it back to you, Eugene. Thank you for your time.
Anthony, always very insightful as usual. And I mean, you've mentioned it with the increase in AUM. We're seeing more and more fund managers using index funds or your funds almost a core stabilizer for global portfolios. But let's just look quickly at the US. And I mean, there's so much debate about it. And if you look at the MSCI, it's still dominated by the MAX 7. You did show the PE ratios of the forward PEs, which is actually fairly competitive or not expensive. And we know there's value in the rest of the index as well. You also mentioned the Russell 2000 did extremely well for clients. But again, back to the MSCI, and if I look at the against global fund, you get the MSCI, and you again buying predominantly MAX 7. A lot of
Well,
people feel that
yeah.
it is running too hot. It is just too expensive. What's the feel on the ground? I mean, you are there. We've seen Powell now almost opting to follow the unemployment mandate because
Yeah.
unemployment numbers are increasing. We know inflation is still worrying. We know US consumers are starting to feel the higher rates. But what's the sense on the ground? I mean, how
Okay,
much
well,
how
I
much
think
legs are there?
okay, well, the good news is if Powell finally starts dropping rates, we've been the last of the major central banks to actually finally drop rates. So I think September's dropping of the rate, you'll see I think an uplift in the market, Eugene. That's why it's so difficult to time these things. I mean, if we're looking out the next 6 months, of course, most people think that the S&P, which is in the 6,500 range now, will hit 7,000 if Powell actually goes ahead and drops rates at least one or two times towards the end of this year. So maybe 25 basis points. Look, the mortgage rates are still very high by American standards. To have 6.5 up to 7% mortgage rates is quite confiscatory and is limiting the real estate market. If that actually can come down below 6%, and if you get the 10-year rate down to the 3% level, that's seen as unleashing a lot more positive animal spirits and frankly more corporate spend. Interestingly, in Trump's bill, just very quickly, it doesn't get a lot of detail, but the infrastructure part of it, there are huge tax write-offs and depreciation write-offs in year one, accelerated depreciation in years 2 and 3. So that actually also boosts a lot of spending on new factories and whatnot. I would just say to you that unlike the Dow Jones or the S&P on its own, where yes, you're right, Mag 7 in the Nasdaq, the Mag 7 can be 40% of the Nasdaq. In our case, MSCI will, because we've got 23 countries. Just very quickly, the largest holding, things like Nvidia and Apple, are only at 2.5% weighting. So actually, by the global standards, it is somewhat muted. We actually quite positive that this broadening out of the market is happening despite tech moving somewhat sideways. It hasn't been the stellar performer. As I mentioned, you've got financials, real estate, all in the last couple of weeks rebounding. And if Powell goes ahead in a week's time, those are the guys, consumers discretionary, even consumer staples, industrials. So we actually see a broadening out. And I think that'll be positive. We don't like this narrowness either of Mag 7. So we're hopeful that you'll get a nice uplift, Eugene, towards the next third and fourth quarters.
I think you hit the nail on the head because, I mean, you mustn't forget this is not like you're buying the S&P 500. After all, it is the MSCI World Index. So you get exposure to Europe, you get exposure to better valued areas or regions as well. And passive is not pure passive, it's almost momentum because as companies improve and earnings improve and market caps improve, you track it in the fund. So you do track momentum to a large extent as well. Anthony, thank you so much. I wish you a restful evening ahead. Thank you for staying up so late and have a fabulous evening further. Thank you so much.
Cheers. Thank you.
Right, and we are moving on to global value, and we're going to cover global value now. And who to do better so than Oliver Alstone, portfolio specialist at T. Rowe Price, the equity division, looking at the T. Rowe Price Global Value Equity Fund. Good morning, Oliver. How are you doing?
Hi, good morning, Eugene. Yes, I'm very well, thank you. How are you?
Fantastic, thank you. Oliver, before you start, maybe just for the audience that don't know your firm by now, but I doubt if anybody doesn't know your firm, but he was established in 1937. He managed in excess of 1.4 trillion US dollars and a multitude of mandates, not only value, but we're going to focus on value now. So indeed, impressive firm that you represent, and we're very grateful for your time this morning. Thank you so much.
You're welcome. Thank you for that kind introduction. So yes, good morning to everyone. My name is Oliver Alston. I'm a part of the T. Rowe Price Global Value Equity team here in London. And I've done a few of these now, and I've noticed every time I've joined, I've followed on from someone who is talking a little bit more about broadening, and then there are more conversations about the value participation. So they've set me up perfectly. I don't know if that's intentional, but it's been certainly a nice way for me to kick off my presentation, because of course I am here to talk about value and then give you some insight of how we are finding different themes across the fund, the Global Value Equity Fund. So if you can move on to the next page, please, Eugene, and I'll just bring a quick reminder of what we do in this fund. So many of you will know this is the BCI Global Value Equity Feeder Fund. And the way in which we identify value at T. Rowe Price is we will search for that controversy in the market. Why is there a dislocation relative to what is a more fair assessment of a value of any given company around the world? And to drive an answer there, we are leveraging our global platform of our experts and our research analysts. And that's where we're really trying to find that insight. That insight and that catalyst is absolutely key to what we're trying to identify and uncover as compelling value opportunities. And then we'll weigh up the asymmetric risk reward. And we're typically looking for a 3-to-1 payoff within the portfolio. And depending on how that risk reward falls, that'll very much inform the sizing, the position sizing within the portfolio. And that creates a strategy or portfolio of 80 to 100 stocks. They are our most compelling ideas. We're at around 95 or so today. We are benchmarked relative to the MSCI World Index, but we do own up to 10% in emerging markets. And I will show you later on in this deck how we get that exposure to emerging markets. And if you could just skip through the next page and then the one after, sorry, the risks page is a compliance slide that I've been made to include, but we can go straight to page 4. And when we think about value at T. Rowe Price, sorry, the one prior to that. Might be the left. There we go. When we think about value at T. Rowe Price and how we construct a value portfolio, we see 3 types of value that work very differently at different times in different parts of the cycle. And in the dark blue at the top there, you can see we've got what we would call defensive value. And these are the relatively higher quality. Okay, that then brings down the relative upside, but these are measures in which that we see attractive free cash flow qualities, maybe there's an attractive dividend yield, and also attractive earnings multiples that really reflect the better quality of these more defensive value names. And they typically end up in the portfolio for a little bit longer because they act differently at different times across the cycle. On the right-hand side of that bar at the top, so in the light blue, we have our deep value part of the portfolio. And this is what you would think it is. These are the cheaper parts of the portfolio. We view these very differently so that we can look at the sum of the parts, be that as a breakup valuation. We can assess the price to book or the price to sales, depending on what the state of the business is. And there can be different pressures that these businesses face, such as the restructuring. It could be management change. It could be any sort of influence creating that disconnect and leading it to be a deep value stock. And the way in which we blend these types of value across the portfolio, this is how we are different from our peers. And then sort of in between, we would classify our cyclical holdings. And typically across time, we will be roughly 50% in the defensive side of the market. And then the balance, that 50%, will be split more equally across cyclical and the deep value opportunities within the fund. We are tilted slightly more cyclical at the moment, just as the way in which the market is presenting ideas to us, but that sort of stays relatively close in terms of how we are positioned across the portfolio. And then in terms of framing that value opportunity set, if we can move through to page 6, please. So why are we excited about value? Why are we talking about value? Well, I can tell you that I'm having a lot of conversations with our clients, prospects, existing clients. They're asking more and more about value because we've been communicating a message for the past year and a half, 2 years now, that we are entering that new regime. Well, we are now in that new regime. And what do we mean by that? Well, capital again has got a price. We're in a higher interest rate, higher inflationary environment that we would call a more normalized environment relative to the post GFC environment that was following 2008 for 12 to 15 years or so. Now, as we move through this environment, we believe that you're going to have to be sharp. You have to stay sharp as a value investor because there will be a lot of disruption. Disruption can create value traps, but it can also create many opportunities. And that's why we're really sort of saying that navigation skills are required. We have to be active. We have to be global. And then on the right-hand side, the compelling case of value, well, the starting point is still attractive. And I've got some slides at the end that I'll prove to you why I believe that is. Even after this value performance that we've seen, we still think this is a good starting point for value. We are still seeing clients top up where they already hold value, and we are having a number of new conversations with prospects that want to own more value in their portfolio. So we then go to page 7, please, and we can now look at the data that tells us why are we in a new regime? What do we mean by that new regime? And why do I say we are moving back to the norm? Well, we've got over 50, 60, 70 years of data here that plots the 10-year US real yield. And you can see across the different cycles how that moves. But what's important here is the light blue line is a decade average. So if you were to split the decades up into different regimes, different impacts, and different influencing factors, you can see where this level of the rate sort of settles across different time periods. Now, when you draw to the right-hand side, you can see that post-GFC, that sharp fall lower was then sustained. That negative rate environment, that negative real yield environment was sustained for a long time. You can see just below zero was the decade average. Now, after 2020, you can see that sharply move higher, and we've started to maintain that higher level. And in fact, it feels like we can still move higher from here. So that is a new regime. The regime change has taken hold, and capital again has a price. This is, of course, as a result of the new interest rate and inflationary environment. Now, why is that important? Because higher rates may challenge some of these lofty valuations seen elsewhere in the market. In fact, you were just speaking about that with the gentleman that was on prior to myself. Now, high rates are also a tailwind for many of the other sectors, such as financials, energy, and materials. So that diversification, again, is starting to be attractive. A lot of investors are turning to the parts of the market that, quite frankly, they haven't had to own for a little while. Now, if we follow to the next page, please, and you know, the natural question there is, well, how do rates impact value and growth performance? Again, if we plot a time series here of the data, the blue line is the US 10-year yield, and the green line is the return of value minus growth. So if that green line moves higher, it means value is outperforming. If it moves lower, it means growth is outperforming. And there are no surprises on the right-hand side. The period we're all familiar with, the growth dominance, quite frankly, couldn't be beaten. The growth stocks, the US market post GFC, but that was also supported by a falling interest rate environment. So you can start to see how that pattern is correlating there. And when we look past back in time, we can see that as that rate environment changes, well, it creates a tailwind for value investment. And we can also see periods where we throw in two commodity bull markets, which is highlighted there, early 70s and sort of late 90s. You can see that there's an additional tailwind for value. So the pieces of the puzzle are starting to connect. We're starting to see everything fall into place. It's proving this year that actually value can perform. And if you believe, like we do, that the interest rate environment is more normalized, value has further room to run. And if we can go to page 9, please, the following page, the reason I've highlighted those commodity bull run periods is that we haven't yet had our commodity super cycle. Now, history would tell us that we are due that super cycle, but the facts also support that. So we've had limits to energy productivity, which is raising the cost curve, which is a further drive to higher inflation. If we see a commodity super cycle, they spillover effect across commodities. It happens broadly and it happens wide. So you can see that a lot of commodities will move higher, and in the long run, they stay structurally higher, as we saw it was about 5 to 7 year period on the previous slide. So we see that there are a number of reasons for why a commodity bull cycle could take hold. It feels like one of the last parts of the puzzle. We don't need it, but it's an additional driver of returns. And this is where you're looking at your sector holdings in energy and materials that would really see that lift come through. And on page 10, well, there's a lot going on in the world right now. There's a lot of reason to be optimistic. There's a lot of reason to be cautious, but there's a lot going on in which a value investor can participate. So AI, artificial intelligence, you think tech, and rightly so, you think tech, but there is so much that goes into this build out that requires these old school industries, such as materials and such as energy. So supplying that clean energy, we've seen multiple deals struck with clean energy providers, certainly in the nuclear space, with big names such as Meta and Amazon and Microsoft, because they need to power this drive. This build out of data centers requires an exceptional amount of power, and they need to drive that with a more cleaner alternative. And that's where the new sort of the transition, the green transition on the third box in, it sort of links with that artificial intelligence play, in that the energy supply is not going away, it's just simply changing. Historical underinvestment, we've spoke about that. And then on the far right hand side there, geopolitics and deglobalization. Well, of course, we all know what Donald Trump has been up to this year so far. We don't know quite what he's going to do for the rest of the year, but you can make a reasonable assumption that it's going to be more disruptive. And this is where we have to pay close attention to supply chains, production facilities, resource nationalism. There's a lot of opportunities there, and a lot of these fall in the value industries that we are looking most at. So across to page 12, so into the next section, how are we playing different themes in the portfolio? What is attractive to us right now? Where is our conviction? Well, we've got three images here just to paint some big picture thinking of why it's important to be active, why we have to be aware, first and foremost for our clients, of those value traps. And this is why we do the work, the fundamental work, to make sure that we steer clear of these. Now, the image on the left was actually taken by Sebastian Malley, who's the portfolio manager. This is in New York. And he took this photo of this self-driving taxi, this Waymo, and he showed us this photo. We were speaking about this, and his question was, well, what else goes in to building out this technology? Yes, there's a car. Yes, there's AI. Yes, there's all this autonomous driving that goes on. But what makes the car? What are the supply chains? Where is the energy coming from? What builds that battery that sits in that electric car? A lot more than just tech. There's a lot more that supports that build out. In the middle, if you think about digital and digital currencies and how we're seeing a lot of regulation change and a lot of things happening on that front this year, well, that can be disruptive to current payment processes. So we have to be aware of, yes, there's an exciting future, and yes, we can participate in that when we apply a more commodity-driven framework, when we think about things like Bitcoin spot prices and so on and so forth. But we also have to take very great care that the existing payment processes, the existing banking system, well, where are the vulnerabilities there if this digital world does take hold? And then on the right-hand side, we've seen what AI can do. Well, one of the first things it was sort of attached to is video games and movies and writing scripts and all that sort of thing. Again, that's another risk that we need to pay attention to, because with risk, it also comes opportunity, and we want to make sure we're on the right side of that for our clients. Now, let's take that one level further on slide 13 and think more specifically about a sector that to us is looking very attractive, and that is financials. This is the biggest absolute allocation within our strategy, and it's our largest overweight relative to the MSCI World Index, which is our primary benchmark. And we're saying it's a rich source of opportunity. And why is that? Well, first and foremost, on the right-hand side, you can see that we've plotted here the spread, and this is the steepness of a yield curve created by the difference between the 10-year yield and the 2-year yield. And you can see that that has inverted for a long time. And as that moves down, that pressures bank and insurance profits. As that rate environment contracts, the profit in which they can drive from their loans and their deposits, it gets smaller and smaller. Now, as that has started to change and move higher, which you can see it has together in both Europe and the US, well, these banks start to look more attractive. And then, of course, the extensive experience that we've got on the banking sector with some experts we've got actually just sat around the corner, we can look at these banks and we can see different businesses. They have been heavily regulated. They are now better businesses. They are in excess capital positions. They've got a better environment to earn more and drive higher return on equity or return on tangible book. And also we've got the potential for things like buybacks now that the regulatory environment is changing. So that's banks. We've got insurance. Insurance very, very quickly. You can think about, well, certainly in the UK, every time that we renew our insurance, be that our car or our house insurance, it's going up. And that's what a super cycle is, where the P&C, so the property and casualty insurers, can raise prices year after year. We are forced to pay it if everyone's raising their prices. Now, when they take in that premium, they have to invest that in what they call a float. Now, for decades prior, or certainly for the last 15 years prior to COVID or so, they were only investing that at a very small return because they have to invest this at a safe market level, so in things like money market securities. Now, all of a sudden, the interest rate environment's moving higher. That same investment is driving a higher return. So companies such as Chubb, which we own, they've started to drive higher returns, both by better pricing environment, also by a higher earnings environment on their invested flow. So the dynamic is starting to improve in financials. We still see a long way for that to run. On page 14, I'll very quickly just discuss what our view on energy is. So on the left-hand side here, we've got the Permian productivity. Very simply, what is Permian productivity? Well, it's how efficiently the oil and gas companies can extract the hydrocarbons from the Permian Basin in this example on the left-hand side. It is essentially a measure of how much oil is produced per well, per rig, or per dollar invested. Now, a higher productivity means that companies can produce more oil at a lower cost. But what we're observing here is that the bull run of US oil production, which you can see is the blue line moving higher and higher, that started to turn. So we can see just before 2022, that started to move lower again. And that's indicating that this productivity is starting to fall. With that comes higher cost as the efficiency level starts to get more difficult in terms of an environment in which oil companies can drill for that additional barrel of oil. Now, as they continue to drill, which is the green line in which they have, the productivity still continues to fall. And when we put all of that together, this leads us to believe that the midterm case for oil is bullish. Now, we recognize that the short term has been a little bit more noisy than that, and we've been able to be selective in this environment. But our midterm, our long-term view remains the same, that oil prices, that the commodity complex has room to be inflationary and move higher. And on the right-hand side, there's the proof of how sort of changing energy, changing your oil price, how they lead things like inflation a lot higher, which I'm sure you guys are all very aware of. So we bring all of that together. We see a higher interest rate environment. We see a higher inflation environment. Structurally, there are reasons for this to stay higher. Now, we do not need a level at which we have to have inflation or interest rates for us to outperform, but structurally, we are in a more normalized environment, and we see compelling opportunities across the value landscape as to why this can continue, why we still can make money in value investing from here. Now, very briefly, if I finish on how we are positioned on page 15, you can see some of the positioning here on the left-hand side. We are overweight financials for reasons I've just spoken about. Materials and energy, again, a couple of pages we mentioned why we're overweight those parts of the market. These are the areas in which you're not getting in your other global growth portfolios or even your core portfolios. So we believe that many investors are under-allocated to these parts of the market. These are rich hunting grounds for value investors, as you can tell by our positioning. I would also add industrials in there as well, which is the fourth name down. We are overweight. So we get that cyclical and deep value exposure where we feel that other investors are not. And of course, that sort of goes hand in hand with our underweight to information technology, so IT and consumer discretionary, the growth parts of the market that is owned elsewhere in your clients' portfolios. On the right-hand side, I mentioned at the start that we can own up to 10% of emerging markets. We do own emerging markets, and we fund that generally from a lower allocation to the US part of the portfolio. Now, the US has grown from around 55% to around 72 or 3% in the MSCI world, as Eugene was discussing earlier. That is a dominant part of the market within MSCI World, we recognize for our clients that we want to deliver a truly global value portfolio. So we use that as an opportunity to fund different parts around the world, emerging markets. We've been overweight Japan, Europe, and Asia, all of which have been key drivers of value for us of late. Conscious of time, I'll skip through page 16, but there's some examples there of names at which we would classify in defensive, cyclical, deep value, and then some of our emerging markets holdings. So if you wanted to think about how we are looking at different parts of the portfolio, this very much shows you there. But I wanted to finish with answering that key question. So I moved on to page 17 here. That key question of first, why global? And then second, why value? Are we too late? Now, why global? Well, on page 17 here, I'm plotting the relative performance of value versus growth. So if the line is positive, value is outperformed. If it's negative, growth is outperformed for Europe, Japan, emerging markets, and the US over the last 4 years, including the year-to-date period here. And you can see that different markets will behave very differently at different times, because Japan, for example, is going through a very different regime than the US. Europe, of course, this year, value has been a fantastic driver of returns since that spending bill has come back, that focus on industrial parts of the markets, aerospace and defense. That has started to happen quite rapidly through the start of this year. But this is why we believe in global. This is why I believe that different alpha opportunities exist across different parts of the market at very different times. And that's how we generate our alpha for our clients, how we look at different parts of the world through a very different lens, but with that very disciplined value approach. And then finally on page 18, to answer that question, well, are we, can we still make money in value from here? Are we late? Have we missed the train? The answer is no. And let me explain this chart to you here. For both the Russell and the EFI index, so think of this as US and then ex-US, we plot the weighted average of the forward price to earnings ratio of growth divided by value, and that creates a premium. So how much more expensive is growth relative to value counterparts? And this is around about, I think it's 30 years or so worth of data. So yeah, 1978. So 30, 40, 50 years of data here. And you can see that the median level, so the median premium, is around just under 40%. So growth is normally at a median level 40% more expensive than value. Now, as of June, over to the right-hand side there, you can see that in the US, that premium sits at 75%. Growth names are 75% more expensive than value names. In EFI markets, so ex-US markets, that premium sits at 88%, the 82nd percentile. So that tells you that growth is still way too expensive relative to value if you're considering history. So everything else aside here, just the entry points in terms of history, well, you can see that the entry point here is still very favorable. We still have a lot of room to go when we consider positioning of value in the context of the whole market. And then finally, just a summary, just to round out a few things that I've mentioned there. The way in which we invest at Global Value Equity at T. Rowe Price is across the value spectrum. That's blending defensive, cyclical, and deep value. And that is where we believe we set ourselves apart from our peers. We leverage our deep insights from our fundamental research analysts around the world, which is where we think that drives our edge. The second point is that we are on a new age. This is where I started. This is why we are having this conversation in the first place about interest rates and inflation and this new regime. Well, it started to take hold. Investors are paying attention. And in that environment, value is proving so far that the playing field is a lot more level. So we're saying here that value can perform alongside growth at different times as part of a diversified portfolio. And on point number 3 there, as we finished, you can see that from the data that I had on page 18, the entry point is still attractive. The valuations are still at a level at which we are finding compelling ideas. We believe that clients think the same, but it's something that we like to stress to say that when you see value outperform, this is a medium to long-term change. This is not just a short-term rotation. And yeah, that concludes what I've got here.
Oliver, thank you so much. We're a little bit pushed for time, but I'm going to take 1 or 2 questions very quickly. First one from the audience. Why do you use the MSCI World Index as your benchmark rather than the value index?
Yeah, it's a great question. So just to be clear, our primary benchmark index is MSCI World, but our secondary index is also MSCI World Value. So in fact, at the very back of the deck there, you will see the performance of both, and our relative performance versus both of those indices is included there. There's historical reasons for it. So when this fund was set up 13 or so years ago, the market was demanding a more core benchmark, so MSCI World. There weren't many factor benchmark demand in the market. But that doesn't mean our process has changed. We have been a value fund through that whole 13-year period, but we do have both benchmarks listed.
Just looking at T. Rowe Price as a business, I mean, we recently did a due diligence on your business, and I mean, you scored extremely high with the investment process and your team capabilities. But in your own words, I mean, if we do agree with the argument that we need to include more value, why T. Rowe Price in 30 seconds?
Well, we have one of the biggest research platforms across the world, and each of one of these analysts is style agnostic. So the way in which they're remunerated, the way in which they are driven is to find the most compelling ideas to fit across the T. Rowe Price suite, which means that we can get a view on a value industry from dedicated investment experts across any part of the globe, across all industries and sectors. That depth of experience is something that we can really draw on, but it also means that we can have a conversation with our growth counterparts. So to understand what's going on in the AI and autonomous driving part of the market, we can sit in and discuss that with our growth and our tech team. Now, a lot of people don't have access to those experts, because that then helps inform where we need to start looking as value investors. So we get a whole holistic view on the market, and we are driven to find the most compelling value opportunities across that opportunity set.
Good point, that, and as I mentioned in the introduction as well, I mean, it's a massive firm where you cover various mandates, exactly what you alluded to now as well, and you can have those constructive conversations. Very last question, and your geographical allocation, very interesting relative to the MSCI, underweighting US, overweight EMs, but we understand MSCI World's got very little EM exposure, so it does stand out like a sore thumb. But let's just talk about China very quickly, because if you look at peer valuations, PE ratios, China really stands out among all regions of offering very good prices. But there's so much debate on China. Can you trust? Can you not trust? You know, where do you go with that? You do have exposure to things like TSM and the likes thereof, but your views just very quickly on China. I mean, what do you make of this region? And then to extend on that, expand on that just very quickly between mainland and Hong Kong. I mean, do you differentiate a lot between the two? Do you only go for Hong Kong listed shares, or what do you look at?
So to start on China, yes, it stands out as an outlier in terms of the relative valuation, but what's important to us is that catalyst. So we have a fixed income team that sits actually just over the other side of the business here, other side of the building, and we are in constant discussion with our China economists and our experts there to understand how that landscape is evolving. Now, we do have exposure to China. We have exposure to what we believe are the best companies in China. We will cap that at around 2% of the portfolio, but we always have to come back to that question. What is the fundamental catalyst? And if we can't get comfortable that the opportunity set more broadly is starting to display those characteristics, then we won't just be driven by valuation alone. We can find better opportunities elsewhere if we need to. So we like China. We're very cautious on China. We want to own parts of it at different times, but we bring in everyone to get a view here. And that's where our fixed income colleagues and our economists actually weigh in the most in the portfolio in terms of our allocation towards China. At the moment, we own the Hong Kong line of the shares. Between the two, it's not something that we would draw out as a strict sort of discussion. Our job is to find those fundamental opportunities. We will figure out with our traders how to best access those at the time. But today, the two businesses that we own the Hong Kong shares line of the shares.
Oliver from T. Rowe Price, thank you so much for your time this morning. It's been very insightful. I can keep you busy for another 3 hours. Really like what you're doing at the business and your entire team. Thank you so much. and we'll hope to see a lot more of you and your firm in months and years to follow. Thank you so much.
Excellent. Thank you, Eugene. Thank you, everyone.
Online and at the ready, we've got Tom Wildgoose, Senior Portfolio Manager at Saracen and Partners, based in London, looking at high quality and thematic stocks and the importance of looking at themes in your portfolio. Tom, good morning. How are you doing?
Morning. Yep. How are you doing?
Absolutely fantastic. Tom, thank you so much for standing by. We've got your presentation up and running.
Let me try and zoom in.
So we're ready. Thank you.
Yeah, please. Okay, great. Well, thanks for the time, everyone. I'm Tom Wildgoose from Saracen and Partners, based in London. I think we've got quite a differentiated and interesting investment approach, long-standing approach. So I'll take you through it now. So if you just flip to the first slide, give a bit of an introduction. So yeah, Saracen and Partners, been based in London for many, many years. Boutique investment management with a really strong and kind of unique culture based around thematic investment. Actually, we've been in South Africa for a long time, 20 years. So it's quite a good foundation for kind of trusting that we'll do the right thing by our clients, your clients. Generally speaking, we have clients in the UK, Europe, private clients, charities, pension funds, etc. In South Africa, it's a broader base. There's some institutional investors there, kind of a range. It is a partnership, which sets us slightly apart. One of the partners is a Swiss bank, J. Safra Saracen, but I'm myself not a partner, but all the guys. The senior guys in the office own the firm, which means everyone's got a sort of a stake in the outperformance, which I think is quite important to bear in mind. So if you flip to the next slide. Now that's just a bit about me. I was at Nomura Asset Management for many years and came over to Saracen a year and a half ago or so. Background is in engineering, computing, but also, of course, finance, CFA and accounting. You can read that in your own time. Whether that's a good photo of me or not, I don't know. So let's go through our investment approach. So 3 key pieces which we can dig into. Thematic quality. What does that mean? That means we're looking for companies that are exposed to what we believe is some kind of long-term growth theme. And we want companies that are able to generate good returns on capital and reinvest that capital in that theme. So the theme provides the opportunity for growth. The quality provides the returns on capital for the company, which investors should ultimately be rewarded by. We are active. We are long-term. So we're thinking in like very long, decade-long type time horizon to produce our estimates of fair value for the companies, and then buy or invest when we see upside to that estimate of fair value. We have an excellent stewardship approach or team, really highly regarded, engaging with all the companies we're invested in, as well as some thematic engagements as well. So I know that's generally of less interest in South Africa, but for anyone who's particularly interested in stewardship and ESG, then I think we do an excellent job there, really, at the top of the industry. So we're going to dig more into the thematic quality now. So if you just flip to the next slide. So here we go. So looking back over the last 15 or so years, what we see is thematic growth has worked very well. What do we mean by thematic growth? It's not just growth, which we know growth as a general style has worked, but in our view, thematic growth is really the key long-term driver of performance. And what we mean by that is companies that can sustainably grow. What does that mean is they generate returns, they take the cash from those returns and reinvest in the business to generate growth. So this is not necessarily invested in the latest boom, the latest fad. It's more those companies that can persistently compound their returns over time to generate growth. That type of company has outperformed the market quite nicely over the last 15 years. The second element of our approach is quality. So we're looking for good companies It don't have to necessarily be the best, but we're looking for companies which generate above cost of capital returns and have a reasonably defensive or safe balance sheet, have good management, and generate free cash flow. If you put those two together, you kind of get a Lollapalooza effect, where those type of higher quality thematic growth type companies have tended to perform very well over the long run. And the performance of the market over the last 10 or 15 years has been good, but not 15% CAGR. So that's the basic philosophy we're looking for. So why does it work? And that's an interesting question. Anyone can easily do a back test and identify a bunch of stocks that seem to have worked in the past 10 or 15 years, 20 years, whatever. But the question is why? What we think is the market tends to underestimate the persistence or the durability of structural trends, i.e. themes, and quality. In general, I would say the market tends to believe that thematic growth will slow down and that high returns on capital will fade down to the cost of capital. As a consequence, the market tends to undervalue those companies. So if you invest in those companies, you will tend to be exposed to a series of positive surprises over time. This year has been tough because that type of company really has not outperformed. There's been some sort of cyclical stocks that have performed very well. The previous speaker, I thought, explained it quite well. This year has been very good for value, particularly in Europe, which is not the type of company we've typically invested in. But over the very long term, it has worked very well. This data goes back over 15 years, but I'd urge you to have a look back much further, going back to the 80s. You can see the same general approach, which is companies that can maintain high returns on capital and can maintain structural or thematic growth have tended to outperform for very persistent periods. And so ultimately, what we're investing in is a belief that the market tends to underestimate the persistence of returns and the persistence of thematic growth. That's why they outperform. That's what explains the observation we see in the market, or in the market historically. So next slide, please. So what do we do? How do we do it? Well, the first thing we do is create a universe of stocks that exhibit the characteristics we are looking for. We do that partly with a quant screen and partly by, let's say, qualitative assessment of industries. So firstly, we're looking for, as I said, long-term sales growth, high growth, and then a higher quality. And for quality, we're thinking about gross margins and return on invested capital. So let's quickly go through those. You can see from the chart, the bar chart on the left-hand side, our thematic industries are in blue, non-thematic industries in the sort of very, well, I say thematic light blue, non-thematic dark blue, and MSCI ACWI, which is our broad benchmark, in the grey. So we give all the companies that, based on industry, a score for thematic or long-term sales growth, for gross margin, and for return on invested capital. Why choose the industries, not just the stocks? Well, we find, particularly for growth, it's industry growth that is best correlated with thematic growth. Certain stocks tend to have periods of high growth, then low growth, and so on. But industries as a whole, which are kind of a more averaged or homogeneous group, tend to, exhibit the underlying characteristics to which all the companies are exposed to. So that's why we focus on industries. So when you've produced the universe, you find generally a higher score for long-term sales growth, a higher gross margin, and really importantly, a much higher than average return on invested capital. Over time, those type of companies have tended to outperform. How big is that universe? The universe is roughly 1,000 stocks. It's, as you can see, not particularly tilted towards large companies, but it is, a quite substantial narrowing of the MSCI ACWI universe from 163 sub-industries down to just 62. So we have narrowed quite a bit. and we have focused on the type of companies we think will work over the long run. Of course, from time to time, that means we will underperform, but we think that our clients and your clients would be best served by investing in this type of company as a kind of a core strategy for the long term, and that's why we do it. Just one quick word on the universe. There's a benefit from the universe in the sense it directs us towards those type of stocks which we think will work in the long run. There's also a benefit in terms of cutting down the wasted time and effort on looking at stocks which we really think won't be interesting. So we've got a kind of a decent sized team, but of course we're time constrained. Everyone is. So the best thing we can do is cut out industries where we think that the probability of success is quite low, and the universe gives us a really good way of doing that. So if you just go to the next slide. What does thematic mean? So we talked a bit about the outcome of themes. The outcome of themes, as I mentioned, is what we call thematic growth. Those type of stocks which can structurally grow for long periods of time. If you look at it from the other direction, what is it that produces that structural growth? Well, it's an underlying change in technology, in demographics, and let's say politics, or in this case, we call it security. So three broad themes: technological change, demographic shifts, and future security provide the environment for companies to be able to generate, let's say, structural growth trend, or structural growth based on a trend, the trend being the themes. Within technological change, we see automation and digitalization as key. We'll come to those, but broadly speaking, AI, the increasing use of data, robotics, autonomous driving, that kind of thing, all fits into technological change. But in addition, things you might not think of. Industrial automation is a huge driver, particularly when we think about the potential for industries coming back to the US. With the best will in the world, it's going to be more expensive to do manufacturing in the US versus, say, Vietnam, unless you bring in a lot of automation into your manufacturing plant, which is where industrial automation could be a huge beneficiary of Trump's reshoring plans. Demographic shifts. Consumption is changing and populations are aging, as we know, particularly in developed markets. That generates all sorts of opportunities for different companies in different ways. Aging, of course, has a big link to healthcare, and we've done very well out of things like Eli Lilly over the past several years. And in evolving consumption, there are increasingly wealthy people around the world, so luxury goods have done very well. But in addition, we see opportunities in travel, in eating away from home, that kind of thing has been a huge change and continues to be a huge change. And those are demographic shifts which go on for many, many years. This isn't a 1 or 2 year cycle, they go on for many, many years. And then coming down to what we think of as a more new area for us, in particular security. We put climate change and security together, which on the face of it, you think, that may be a bit strange, but actually there's clearly a link. As climate changes and resources become scarce or move in different places, then the security or political security of companies comes into question. If we only have to look at the fires and other natural disasters that have happened in the US to think, okay, security could be an issue for some of these companies, some of these communities, which will generate opportunities for certain companies, and ultimately that traces back to climate change. And then secondarily, an entirely new sort of segment to our pie, as it were, is the security theme directly. Clearly, the invasion of Ukraine by Russia and the conflict in Gaza and various other conflicts around the world, not to mention the deglobalization that's going on, our previous speaker mentioned, has created a lot of security challenges. So we think there's an opportunity in things like defense, and you might be surprised to hear things like banking, which all link to that new security theme, which we think is going to persist over the coming years. So if you just go to the next slide, there's a bit more detail, which to be honest, I've already given you, but here's a bit more of an example. What do we say in digitalization? As I mentioned, things like digital commerce, cloud, and so on. In automation, well, we talked about robotics, industrial automation, but of course, there's things like artificial intelligence in supply chains. There's lots of things there which continue to drive opportunities for companies to reinvest in sustainable growth. In demographic shifts, we talked about that already. Health and nutrition is a big one. Travel and leisure is a big one that we think a lot about. In aging, we've talked about that too. Healthcare efficiencies, so retirement solutions. These are things which continue to challenge particularly Western societies and create opportunities for companies to invest in. Future security, we think is a really interesting one. Of course, we all are familiar with climate change and the effects, but security, our new theme, I think is quite interesting. Resource security, protected markets, which is, of course, one of Donald Trump's big drivers, and then, of course, cyber and defense. We ourselves have been affected by cyber attacks, and many companies around the world have. So companies that can help protect others from such cyber incidents are clearly in the ascendancy. Next slide, please. So here we go, digging into security. So when you think about cyber and defense, every week that goes past, there's another cyber incident that comes up, either some kind of politically motivated attack. We are aware of, bot farms in Russia attacking companies in the West, but not just that. There's blackmail attempts and so forth. So a company that we're invested in, nothing to do with security, but was affected by a cyber attack earlier this year, IMI, has spent an enormous amount of money improving the capability of their IT systems to withstand attack. So they announced on their recent call, this is a relatively small UK industrial, that they'd spent 25 million upgrading the cyber defense or cyber security software that they have and hardware that they have. That's quite an enormous spend. If you multiply that across the entire economy, it's a huge opportunity for companies, and I'll come to it later, like Fortinet, that make firewalls. Energy security, food supply. To be honest, again, going back to the previous speaker, yes, there is clearly an issue with access to resources. You see with the way India is behaved in relation to Russian oil, they clearly see an issue. They need to get access to oil. They need to get access to energy. They're prepared to buy from Russia despite sanctions to get access to that. That's created a conflict with the US. And I heard this morning that the 50% tariff on India is going into force simply because of that. So clearly, resource security is a big issue. And then protected markets and supply chains. Well, COVID was the start of it, where supply chains started to get fractured. And I think tariffs and so on are, the latest iteration of this sort of deglobalization type effect, which is going to make a big difference to lots of companies around the world. Next slide, please. So let's have a couple of examples. First is Fortinet. I just mentioned that briefly a minute ago. What does Fortinet do? Fortinet makes firewalls and firewall software. So this is an interesting company. Firewalls are pieces of hardware which are installed essentially between your own internal infrastructure and the outside world. The idea is to repel threats or attacks, I should say, into your internal IT infrastructure. Of course, the IT infrastructure is changing. It always used to be you had all your own IT equipment on site. Of course, with cloud, that's changing. So as that changes, there's an opportunity to Fortinet to change their technology to maintain those defenses, and that's exactly what they're doing. And on top of that, you need to layer software which of course Fortinet can do. So as cyber becomes a bigger and bigger issue, and of course as more and more companies get attacked, we think there's a huge opportunity for Fortinet and others like Palo Alto to benefit and sell more and more technology. It's a steady growing company. It earns a very nice return on capital. And interestingly, companies, or customers, I should say, tend to pay upfront. So there's a really nice cash flow generation characteristic whereby the customers pay and the software and the hardware is delivered later, which means they get much more cash flow upfront than you would have expected from other similar sized companies. Next slide, please. And so here we have a little bit more detail. Performance year to date has been a little bit flat. It hasn't really kept up with the rally, but over the course has been more or less neutral. Had a little bit of a weak point last quarter, but we think will ultimately do very well. We think that it is in a relatively unique position to provide the security that companies need. There are relatively few companies that are able to provide security to the same extent that Fortinet and others. Only 2 or 3 other competitors are in that category, which is a really nice oligopoly, and it implies that they'll earn good returns in the future. I just wanted to pick out one thing here as an aside. You can see on this slide on the right-hand side, a lot of what let's describe as hieroglyphics. Here, we talk about our ESG stewardship and engagement work. I mentioned that we do an excellent job here, and I think it's really a standout for us. You can see we look at each company in a lot of detail and rate them in a lot of detail on E, S, and G. The detail being based, broadly speaking, on the UN SDGs, which are the Sustainable Development Goals. You may be familiar. So we rate each company on that. We aggregate those into an ES&G rating, and we rate each company on ES&G to produce an overall score on each company. All of that's proprietary. Of course, we use external data, but you can see this company, overall ESG rating A, we rate it green on E&S. G, we have a kind of an amber warning on governance. There's some minor issues in the way the board is structured and so forth. That gives you a little brief insight into the detail we go into on ESG analysis. Layered on top of that is the engagement work we do. So if there's any issue, we have a whole team here sitting right beside the investment team, working with the companies to try and improve any area where we see an issue. There's stewardship and engagement activity going on all the time. And in fact, we even try and work with our clients to work on areas of shared interest. So it just gives you a snapshot. I'm aware that in South Africa, this generally is of less importance for the fund selection process, but for those that are interested, I'd really urge you to get in touch with Malcolm Hoare, who's the kind of representative for us here in the country, and we can give you a lot more information. So just thought I'd put that there so you've got a bit of a snapshot of what we do. Next slide, Pete, please. Another security company, CME Group, which you may or may not have heard. What does this one do? This company has almost, I would say, very large market share in operating derivatives and futures, derivatives contracts for a variety of financial securities. So there's futures and options on interest rates, stock indices, exchanges, commodities. Why is that a security thing? That's an interesting question. Well, as the market becomes more volatile, and particularly in things like commodities becomes less predictable, then companies and investors seek to hedge their risks in relation to those type of, let's say, exposures, and they do that through derivatives. So, for example, during that period of the Liberation Day tariffs, volatility spiked hugely. The number of contracts which CME sold or brokered, let's say, it rose absolutely enormously. And that just goes to show that as the market or the world becomes less certain and the security less guaranteed, people seek to hedge those risks in a similar way to insurance policies using derivatives or financial instruments. And CME is absolutely well placed to benefit from that trend. Next slide, please. And you can see here, bearing in mind what I mentioned about the kind of the Liberation Day tariffs, how has CME done over the last couple of years, and in particular this year? Well, it's done very well. Why? Because people have come to recognize, that this company offers a very unusual but extremely valuable service to economies worldwide and companies worldwide to hedge their commodity, interest rate, and so forth risks. This is almost a monopoly on that type of service, and certainly on some instruments, it's the only place to go. There is a new entrant to the market, and that caused some worries previously. But in reality, the chances of the new entrant making headway is very low. It's been tried before and not succeeded, which again talks to that idea of persistence we talked about at the beginning. And I think that's the last slide. So with that, if you just go to the next one, yes. There's just a bit of information about the feeder fund into which we feed, but that's the last slide. So I'll open it up for questions. I think there was one on the Q&A there.
Yeah, Tom, thank you very much for that. I'm going to pause there. We're a little bit pushed for time, but I am going to send that question through to you. You can maybe reply on that, and we can circulate that to the audience as well. Tom, you did make mention of Malcolm based here, so your representation this side. So to our audience members, if you want any more information on Saracen, the Equisar Fund, please give us a shout, or we can get hold of Malcolm as well, and to have a discussion. Very interesting thematic investment and how it can find way into clients' portfolios. Tom, thank you so much.
No problem. I mean, I can see the question. I can give a very quick answer. Do we use ESG screening? Yes, we do. And do we adjust the discount rate based on ESG risks? Yes, we do that as well. So I think the question captured it quite well. It's a very sophisticated. I've been in the industry a long time, and I haven't seen a better one or better system than that we have at Saracen. So yeah, any more detail, you're welcome.
Good to know, Tom. Again, thank you so much. Really grateful for your time this morning, and we'll stay in touch and get you on board soon again. Thank you so much.
Thank you. Bye.
Continuing with the global equity, and joining us now is Dr. Jimmy Muchetere, from Investec Investment Management team based in London. Good morning, Doctor. How are you doing?
Good morning, Eugene. How are you doing today?
Very well, thank you so much. Thank you so much for joining us this morning. Looking forward to your presentation. We've seen quite a bit of the Investec Investment Management team, and really grateful for you to join us all the way from London to share your latest views. Thank you so much.
Fantastic. Thank you. Thank you very much. So as you said in the introduction, I'm Dr. Jimmy Muchetere. I work on the Investec BCI Global Leaders Feeder Fund, and I am a specialist healthcare analyst. And I'm going to be taking us through a deep dive of why we think the future of healthcare is intelligent. And the objective here is to show you how at Investec we marry the macroeconomic picture, the thematic, with the deep fundamental research. But before we get into the weeds, a little bit about who we are. So maybe the first thing to say is we are not 91. Investec Wealth and Investment has always had investment capabilities since the inception. The investment team is held within Investec Investment Management, which you can see in that pie chart there. And this is where the investment team is. The separation from 91 allows us now this opportunity to talk about the broader investment capability that has always lived within this group. And this research capability has been in the making for over 20 years. Over time, we've evolved from structuring share portfolios, segregated mandates, and unit trusts now into a business managing over 330 billion assets under management across 25 funds, some of which have got 15-year plus track records. So we are now a business that's called Investec Investment Management, and informed by a deep bench of research analysts, fund managers, as well as global strategists. What is our philosophy? We are a quality growth at a reasonable price strategy, in speaking specifically to the BCI Global Leaders Fund. And what do we mean by that? We're looking at companies that have got sustainable competitive advantages that are exposed to structural growth themes. This is where the thematic side of things comes in. And we use the macroeconomic view as well as an overlay on top of that. And I'll show you how that works shortly. We're looking at businesses that create value, and how we define that is return on invested capital sustainably above its cost of capital, that are excellently managed. We mean both operationally and as well as allocating capital. And then we use our deep analytical strength and research depth to find those companies. And then the Global Investment Strategy Group helps us to manage our risks, avoid some of the value destroyers, and then we build all that into a global large cap fund built around conviction and patience. So our portfolio would look exactly as I've described. It's global multinational champions. It's high conviction, but with around 40 names in the portfolio. We are also quite well diversified, especially compared to many of our peers. We aim for long-term value creation, so we're looking for compounding here. And that means we tend to avoid highly cyclical and volatile sectors such as utilities, telecoms, and real estate. We incorporate macroeconomic trends to kind of fish out what are the long-term structural growth themes that are there. And today we're going to focus particularly on one of them. And then we are willing to pay a fair and reasonable price for good companies, so that we can be along for the ride for the long term. Valuation is not a trigger. And so we find that our strategy, the Global Leaders Fund, is invested in many sectors, offering broad opportunity as well as diversification. A quick word on the macro. We've got what's called the Global Investment Strategy Group, which consists of 10 members. This group determines the risk appetite across our global business, and then that is then taken into the different strategies that we run. As I mentioned, we run over 25 different strategies. It helps to identify long-term threats as well as opportunities, a diverse membership with people sitting in the UK, South Africa, Switzerland, and a range of capabilities as well: economists, strategists, analysts, and portfolio managers, combining to over 350 years of experiences. Now, zeroing in on AI, on innovation in healthcare, what I'm going to do is use the rest of the presentation to show you how we do the deep fundamental analysis and then how that features into our portfolios. So we take this theme of healthcare. Some of the challenges, including demographics, and the US is a microcosm of what's happening everywhere else in the world, where people are living longer, and this is expected to increase quite significantly. And the US is already spending, 17% of its GDP on healthcare, and is set to increase as well. So the challenge here really is, how do you provide quality healthcare to more people for a lower cost? And one of the solutions, of course, sits in innovation with new therapies, devices, better prognostications, and earlier diagnostics, all informed by AI. Now, AI is not new to healthcare. In fact, AI by itself, it is not new. It started in 1942 with Enigma, which was broken with AI. And then the first chatbot was in 1965. We all remember 1997 when Deep Blue beat Gary Kasparov. And then, of course, in 2022, November 22, the chat GPT moment. It's been in the making for a long time. But in healthcare, it's also been involved in a lot, as I will show you in a minute. Now, just quickly defining terms here, AI means different things to different people, but for our purposes, AI is an umbrella term that includes making machines smarter. In terms of healthcare, the three subsets of AI that are really important are natural language processing, NLP, which is focused on teaching machines or computers to understand, interpret, and generate human natural language. And then machine learning, which is a subset that involves systems or algorithms that can learn by themselves. And then deep learning, which is all about deep neural networks to detect patterns with minimum human involvement. What are the key applications of AI in healthcare? Diagnostics is the number one, which is all about using AI in imaging as well as early detection disease. And I'll give you some examples. Personalized treatments, for example, genetic profiles and how someone can react to drugs. It's called pharmacokinetics and pharmacodynamics. Predictive analytics, to prevent the disease before it comes, if you can prevent cancer before it happens, as well as predictive models for proactive patient monitoring. So somebody has an ongoing chronic condition. How do you monitor them proactively so that you prevent the complications happening? Now, moving on to specifically some of the use cases of AI in healthcare, starting with drug discovery, there are 7 ways generally that AI is transforming drug development. Now, drug development traditionally is very costly. It costs about $2 to $3 billion to bring a drug to market, and it takes a long time, between 10 and 15 years, from idea conception to actually getting the drug onto the market. Now, AI is potentially changing that. And how is it doing that? Starting from target identification and validation, this is a process that can take between 1 and 3 years. And then preclinical testing, which is typically happens in animals or animal models. Now, AI can take a lot of that away. Drug dose optimization and prediction of drug properties. How are people going to react to the different drugs, which often results in adverse events or side effects. And then genomic data, how do different people react to different diseases. And then you put all those things together, you accelerate clinical trials. So with AI, the potential is, instead of spending 2 to 3 billion developing a drug, if AI is applied across the whole landscape of drug discovery, what might actually happen is it might cost somewhere between 500 million and 1.5 billion, which is massive savings. And instead of taking a decade to 15 years, it could take 5 to 8 years because you massively increase the time reduction. And that is very important in biopharma land, because if you can bring a drug to market earlier, it means you've got a longer patent life, because patents are issued with 20-year lives. So if you can get the drug to the market as early as possible, then you've got a long patent life left. And it also means that you've got more cash flows, because if you think about it, if your cash profile ends at when the patent expires, you've got more cash flow. So it's both in terms of time as well as in money. And so AI is helping already to accelerate identification of new potential drug candidates. Machine learning models are predicting molecule interactions. This is about drug interactions. So someone taking a cocktail of different drugs, how do they interact? And then automation to reduce clinical trial and costs. A lot of that is administrative work, recruiting patients, taking their data, making sure their data is correct. And then when the trial is done, collecting that data, cleaning it, scrubbing it, putting it into a regulatory file, and so on. And that can take the best part of 2 years, just doing the administrative work and then analyzing the data. And and AI can take a whole lot of that work out and speed things up massively. And then personalized medicine, where one drug might work very well for some people, but not other people. And we're seeing this, for example, with the obesity drugs. For some people, they lose, 25% body weight. For other people, 5%. Some people have a lot of side effects, other people don't. So if you can kind of personalize that using AI, that can save a lot of money and costs as well. In diagnostics, AI is transforming radiology, pathology, as well as ophthalmology. In radiology, for example, AI is being used to spot anomalies on X-rays, CT scans, MRI. So by the time somebody moves from the imaging center back onto the ward, for example, AI has already flagged some lung nodules or some brain bleeds or some fractures. And this is very, very crucial, particularly in workflow triage. I used to work in the accident emergency department, and trying to prioritize categorize urgent cases was always quite difficult. But if you can catch a suspected stroke case or a pulmonary embolism case and flag that instantly, you could actually save someone's life. Now, right now, it's not possible because you send someone to get the MRI scan or the CT scan, and then you have to wait for somebody, a radiologist, to come and interpret and say, oh, this is actually urgent. But with AI, that gets flagged immediately. And how it does that is through that machine learning, where you train a model on millions and millions of X-rays, CT scans, whatever. This is what a brain bleed looks like. This is what cancer looks like, etc. And then it can easily pick up those those patterns. So it can automate a lot of those processes. In pathology, it automates tumor volume measurement or organ segmentation for radiation planning, as well as combining imaging with clinical data, with clinical history, with genomics to give a complete picture of the patient and massively speed diagnosis. And then what we're finding is that in ophthalmology, this is one of the earliest and most successful use cases of AI. Key case is a condition called diabetic retinopathy, where someone's got long-term diabetes or uncontrolled diabetes. And basically using AI to detect diabetic retinopathy at a primary care center, so a doctor's surgery or at a clinic, and that preserves valuable resource of an ophthalmologist, and that massively increases efficiency. The first FDA-cleared example is something called IDX-DR, which is the first fully autonomous AI diagnostic system approved in the US, and it detects diabetic retinopathy in anyone. So that is massively improving healthcare delivery. Another area is virtual AI assistants, where AI-powered assistants now can interact with the patient. So you can ask questions in your language, how you understand your problems, and integrating with healthcare records and natural language processing means you can get expert-level answers in a language that you can understand as well. A few case studies. One is lung cancer, where early detection is massively improving because of AI. And this is coming from advanced imaging analysis using machine learning models to predict both prognosis and patient responses to different therapies and personalizing those treatments as well. This is an example of pathology where someone gets a biopsy of tissue, and then instead of taking a week or several weeks to process and interpret, AI can rapidly process the data, reduce noise, and flag any areas that might be suspicious of potential cancer. A big cost in healthcare is in terms of administration. Pharmacy efficiency is one area. There's a technology called optical character recognition, or OCR, and this helps to translate printed or handwritten text into digital data, and then you combine that with AI validation. It means that AI can check the accuracy of a drug name, the dosage, interaction. Is this the right patient? It can check whether the batch number is correct, expiry hasn't happened. It helps to reduce waste, fill in insurance forms, detect fraud, claim information processing, as well as processing of payments as well. So OCR and AI is increasing efficiency for pharmacies by up to 90% and speeding some tasks 4 times faster. One of my favorite examples is surgical robotic assisted surgery, where with robotic assisted surgery now we've reached sub-millimeter precision. But if you add an AI layer on top, you can on the operating theater improve dexterity and ergonomics during the different procedures. When I used to work in orthopedics, for example, sometimes you open up a patient and something you were not expecting, you have to get someone to do an image of that patient, wait for an answer, then decide how you proceed. Now with AI, you can do that with immersive 3D visualization. One way I like to explain this is AI with robotic assisted surgery is like a flight simulator for doctors, where you can practice different techniques and see how that improves your performance over time, and you can use it during the surgery as well. Hospital efficiency, one of the biggest problems, you've got disparate on-premise data sources, so coming from different areas. But if you can unify that on a cloud platform and then apply a generative AI layer on top, that can massively improve healthcare automation. You know, HCA Healthcare, one of the company's biggest hospital operators in the US, has registered a 70% increase in automation. So we see AI in healthcare for the future, enabling more precise and personalized care, integration with wearable devices, helping to continuously monitor healthcare cases, predictive analytics, to prevent strokes. So, the days where someone would just drop down dead because of a stroke or heart attack could be over, and then AI-powered robotics. There are challenges and ethics to be considered, like in any other area, but more so because it's private healthcare, resistance to adoption, interoperability issues as well, but data security and privacy concerns remain important. So in summary, we see AI having an impact across the whole healthcare paradigm, from diagnosis and prognostication to designing drugs, clinical decision support, remote monitoring, reducing side effects, as well as improving healthcare costs. So how do we take all this deep fundamental work and express it through our portfolio? Here are a few examples of companies that we already own in this Investec Global Leaders Fund. NVIDIA, for example, with NVIDIA Clara, helps doctors with AI tools for medical imaging and lab testing, as well as finding new medicines, so drug discovery, for example. Intuitive Surgical is the global leader in robotic-assisted surgery with the Da Vinci 5 robot, and it helps surgeons make more precise surgery, as well as make better decisions during the operation. So you've got a lot more information, you've got a more holistic picture. Google has many different healthcare businesses. DeepMind and Google Health use AI and particularly deep neural networks to design proteins, whereas Verily is more focused on clinical trials, population health, as well as wearables. Palo Alto is one of the biggest cybersecurity companies in the world and helps keep the data safe and gives real-time authentication of data for use in medical applications. Amazon Web Services has got a very specific business for storing healthcare data, processing it, and supporting better clinical decisions. And Apple, everyone knows about the smart devices through Apple's health tools. And then we've got a number of healthcare companies, Novartis, Eli Lilly, Danaher, Boston Scientific, and Stryker. They all use AI in different ways, either for drug discovery or improving the medical devices that they use to be smarter, and integrate all that so that it's a much more holistic and continuous treatment pathway for people. So just to finish, why invest with BCI, Investec Global Leaders Equity Fund? We've got a long track record. We've got a strong research capability for deep fundamental analysis, which combined with macroeconomic and a thematic overlay, which gives exposure to structural growth themes in the best global opportunities. And we capture that compounding through conviction, long-term investments, while still being diversified across around 40 different stocks. And we've got specialists that do this on a day-to-day basis, and we are very happy to take your questions now.
Thank you, Dr. Mchechetere. It was very insightful indeed. I'm going to pause there. We're running a little bit short of time. But as you mentioned as well, the Global Leaders Fund on most of the big platforms. It's been a long-standing fund. And what I can add, it's well priced compared to some of the other big global quality funds as well. Definitely something to look at if you still want to get exposed to global quality. But obviously, a lot of different names in there that you don't usually see, with the exclusion, obviously, of Apple and NVIDIA. But a couple of very interesting holdings in your portfolio, and you explained now very well why you hold those companies. It's been delightful to have you with our session this morning, and again, thank you so much for your time.
Pleasure. Thanks for having us.
Fantastic. We are moving on, trying to catch up a little bit of time. It's my privilege to welcome a very well-known portfolio manager from Lindsell Train, Ben van Leeuwen. Good morning, Ben. How are you doing?
Morning, Eugene. I'm very well. Thanks very much. All right. I thought I would just take you through a little introduction to who we are for those who are not as familiar, and then give you a couple of stories on both sides, what's working, what's not working, how we're thinking about the portfolio, and then a little bit of turnover, which is incredibly rare for us as you're here. And here are the usual disclaimers. Great. I love starting with this slide because it really helps exemplify a core tenet for us, which is low turnover and really steady buy and hold discipline. So the strategy has been going since the early 2010s. The firm has been around since the year 2000. And over that period, we've only bought 9 new companies. And we've sold even fewer if you exclude special corporate events. Which we had one recently. You'll see Hargreaves Lansdowne twice. We bought it around 2018, and it was taken off our hands at a 50% premium fairly recently. The key message here is simply that we are looking to buy extremely high quality companies and then really interfere as little as possible to a slightly unusual level. 4% turnover is fairly atypical. And despite that fact, you'll see here that we have managed to maintain an extremely high average return on equity. So all that simply means is that the companies we bought and held on to in a very loyal manner have remained high quality over time. We've only been able to make very few adjustments, and yet it's still almost double the quality of the index. For that privilege, we do pay a mild premium. You'll see there at the bottom. We are not fussed about that for one very simple reason, which is that the underlying returns are infinitely more important than your starting yield or multiple. And here's a very simple worked example to demonstrate that. If you work out this calculation and you manage to find a company with these high returns that we're looking for, and they are maintained over your holding period, you can pay seemingly over the odds. You can even have that multiple regress to the market multiple over time, and yet you will still lock in a superior return thanks to the better compounding that the company is able to achieve over that period. So that's what we're looking for. Occasionally, of course, you do get a high quality company at a more attractive multiple, and I think we've found a few. But nonetheless, this is what kind of underpins what we're really trying to do. High quality first. These are some of the areas we focus on and have always focused on. Application software, certain parts of financials, especially stock exchanges and asset managers, information services, and certain parts of staples, consumer staples. And we avoid utilities, capital intensive companies, and so on. I think the numbers at the bottom are quite interesting. 60% plus of our portfolio are in these areas of great interest compared to only around 15% for the index. And then on the flip side, the areas we avoid make up only 3% of our universe, but 50% plus of the index. So we do look very different. When there are sectors that do unbelievably well that we have no exposure to, we do feel it. We have no problem with that. This is a differentiated, highly concentrated buy and hold strategy. It's only 24 names. So our performance does differ meaningfully, but we think it's still nonetheless the right approach over time. There is no index hugging going on here. So now let's talk about 3 more positive stories, and then I'll talk about 3 more challenged areas. The first is the largest holding in the portfolio, which is Nintendo, at 10% of the portfolio, give or take. It's had a phenomenal year. We've seen the launch of the Nintendo Switch 2, its first new console in 7 or 8 years. And you can see that there on the top right. And it's gone bloody well. It's a record-breaking launch for the company and also within the context of all consoles. So that's the PlayStation 2, that's the Xbox, and so on. The graph shows you hardware units for their previous console, the Nintendo Switch, and its derivatives in blue and gray and so on. And then you've got this brand new console, and that is a estimate for the first year from Bernstein in red. I think there was a bit of anxiety coming into this launch about how well the company might perform. And then when it has done well, we've seen a re-rating off the back of that. We had a higher level of certainty for a couple of reasons. The first was that the company was scarred by a console switch in the past, going from the Wii to the Wii U, and they've just been so focused on getting this transition right. And so in advance of the launch, they've been collecting a lot more data on their customers this time round, signing them up to online accounts, and the cross-sell has just been so much more successful. It has a really good value proposition, a great initial selection of games, being sold at a higher margin these days than in the past because people are downloading them versus buying them in a store. And we're extremely excited about the next few years. If you look back to the previous cycle, actually, it takes about 5 years for software sales to really accelerate. So we've got a good, half decade ahead of us of really strong revenue growth off the back of that little console there. And yeah, we're pretty excited. The next area that's been going really well and continues to do really well is sports rights, which is one of the most interesting subsectors within the media sector more generally. We have exposure in a number of ways to media. We've got Disney, we've got UMG, so we invest in film, TV, and music. But within sports specifically, we own TKO, which owns the rights to WWE and the UFC, which is MMA. And we also own some sports clubs. It's just been a really fascinating year. Apple has now been bidding for F1 rights. There's been a couple of huge transactions within the NBA for the Celtics and the Lakers at 10 times plus multiples. And then TKO itself only last week or week before signed a new deal for UFC for $7.7 billion, which is a huge step up for that franchise and extremely exciting. That locks in those that revenue, that cash flow now for nearly a decade. And let's see what Ari and the team go out and do with that. But a really strong area for us and one we're very excited to keep allocating to. And then finally, information services. We've talked and heard a little bit about AI already. This is where we're seeing it in companies like RELX, which is a legal, medical risk kind of data provider. The London Stock Exchange Group, Intuit, which does accounting software and so on. All of these players that have incredibly valuable data, have been selling it, getting into their customers' workflows, are now seeing an acceleration. And here's a perfect example, which is the legal segment for RELX. Back in the day, it used to just sell case histories. Now it sells a kind of AI-enabled legal assistant, and that's the kind of revenue acceleration we're seeing from 1% to 2% up to nearly 10% now, and at higher margins, going from mid-20s to mid-30s. That's just a really nice, clean example, but we are seeing it across a number of our other companies as well. Now, on the flip side, spirits continue to be a bit challenged. This is an area we've always had exposure to via Diageo and Brown-Forman, the owner of Jack Daniels. This slide was actually made by my colleague, James Bullock, the portfolio manager. And it just puts some of the headlines of the recent few years in context, I think. This is going back to the 1790s, and you can see that per capita consumption has fluctuated a bit, but it's not been the big driver. That hasn't been the main volume driver for a company like Jack Daniels. You can see there from the 1950s up until roughly the present, it's had a huge increase in bottles sold despite this trend. So yes, we are looking at demographic change. Yes, maybe there has been a bit of a post-COVID slump and so on, but there are still very important drivers in terms of premiumization, the international opportunity, and frankly, the GLP-1 thing. Maybe there's a bit of scaremongering there, but we shall see. And the multiples are definitely not challenging at this juncture. That's for certain. The second area that's been struggling a bit recently is luxury. We have one exposure here via Prada. This just shows the return for a basket over the last 4 years. As you can see, they were, excluding Kering, which is a bit of a special case. trucking along, but then there has been a bit of a derating since the start of the year. Chinese spending is slowing and so on. I think with Prada, though, we've got a pretty interesting case on our hands. If you look at these two graphs side by side, you'll see that Prada is in gold there, has the second best kind of organic revenue growth of the group over the last 4 years, and yet trades at one of the lowest multiples across the entire sector. We think that's unwarranted. I mean, there are some reasons. It's listed in Hong Kong and doesn't yet have an Italian listing, so the liquidity is not quite as great. And it's not a pure mono brand. It has actually got a few now, but it's definitely not as diversified as an LVMH. And conglomerate seems to be getting a better multiple these days. But I just think this discrepancy is simply too great. And yeah, it has derated and we've been adding. So potentially an interesting situation there. No new luxury names have been created for 50 plus years, and we don't see any coming through. So, and then this is the final one I just wanted to mention, which is fairly stock specific to a company called FICO, which is one of our data analytics companies, a US credit scoring company. There's been a bit of chatter that the head of the Federal Housing Finance Authority has been trying to promote a competing score called Vantage Score and promote something called Lender Choice. And I think that has some market participants worried. We are not. Yes, FICO has been increasing prices considerably. And if you look at the percentage increases, they seem dramatic. But at the end of the day, you're still only charging a couple of dollars for an incredibly important credit score that underpins the largest financial transactions of people's lives, namely mortgages. And I think a $5 score within the context of multiple thousands in total closing costs is not where regulators should necessarily be focusing. And I think it's got some easy wins and some easy points for Pulte, this head of the FHFA. But for some of the reasons laid out in this paper, namely the entire industry has been built off the FICO score for the last 50 years, all the risk modeling, all of the secondary market of bundled mortgages being assessed on their FICO scores and so on. It truly is very plumbed in, and we are not as concerned as some seem to be at the moment. And this happens every so often, especially when you've got a player that has been putting through such incredible pricing. This is where I wanted to finish, which is just to explain that we have made a change to the portfolio. It doesn't happen often, but we have. We sold a company called Cow, which for those who are unfamiliar, it's kind of like the Procter & Gamble of Japan, and we bought Alphabet. Cow, suffered a bit during COVID. I think the multiple then came back ahead of a recovery in earnings, and it was actually screaming pretty expensive. It has not grown as quickly as we wanted to overseas, despite owning some pretty phenomenal brands. There was an activist that we supported, we engaged with the company, but we didn't see enough progress. And so even though we are unbelievably patient and long-term investors, we had finally had enough. And we pivoted into Alphabet, which we think fits far more securely into the current portfolio, trading at an extremely attractive valuation. It's a name we have owned in our US fund and we've tracked very carefully. And I think ahead of the antitrust ruling in August and so on, we were given a pretty nice window to buy in at a very attractive multiple, which has already started to unwind a bit. But I think we're very happy with our initial purchase price. And I will pause on this slide, which is the portfolio as it stands today. Just one last thing to point out, which is that we have one new holding, the anonymized stock, which we are not quite yet ready to reveal. But hopefully the next time we will convene, I'll be able to introduce that one as well. And thanks very much.
Ben, thank you very much. And we're definitely going to keep our eyes open for that secret stock you're going to put in your portfolios. Ben, no questions from the audience, but I've got one question quickly, and it's got to deal with performance. I mean, Lindsay Train's got a phenomenal track record, but the past 2 years has been tough. You've mentioned some holdings, post-COVID, that isn't a bit of a slump. But if I look at your portfolio and the quality of the companies and the potential growth in earnings, it's almost like, why is price not catching up? And maybe you can give us a short answer on that. And in the same breath, I mean, what stops you from capitulating? Because I mean, it must be very tough to hold on to these really good qualities. You've done all the work, but it's almost like the price is not getting there.
It's a great question. It's something we feel very keenly. I think the first thing is that we are able to keep holding because of the structure we have in place. This is not one fund within a larger group where someone 20 offices away might finally lose patience. We're completely employee owned. The founders have been there since 2000 and are going absolutely nowhere. And you can weather these moments, and hopefully that means we then lock in the next the rise whenever it comes. Yeah, we share the exasperation. We sit down with the CEO of the London Stock Exchange Group, and the results that they're generating do not match the share price performance. It can happen. We feel it keenly because it's super concentrated. LSEG alone is 9% of the fund. So if that if it tracks sideways for a couple of years, that is a massive drag. But then, when Nintendo goes up 50, 60% in a year, you also feel the full force of that as well. I think the other thing to say is that, yes, the staples have had a really tricky post-COVID period, and that has also been frustrating. But one change we have been slowly making is starting to invest a bit more in the information services sector. Companies like Relex, like FICO, like Intuit. And so maybe the portfolio is skewing a bit more growthy over time. So there are small changes happening under the hood, but we don't make any huge adjustments.
We might very well be in a very different situation a year or two from now. And again, looking at some of the growth in earnings and what you hold in the portfolio. Let's see, time will tell. And like I said, you've got a phenomenal track record. We've seen Nick a couple of times. James has been out here a few times. But we'll keep a close eye on your fund and how you're doing. Ben, again, thank you so much for your time this morning. It's been always great to have you on board. And greetings to your team in London as well. Thank you so much.
Thanks, Eugene. Until the next time.
Right, we're moving on to global emerging markets, and we will have a quick update from Sands Capital on global equity and their perspective on emerging markets, and more so, why bother with emerging markets? Because it's something that's added a lot of volatility to client portfolios. Maybe this is the time to reconsider it. Dan, thank you very much.
Hello, I'm Jack Mayer, Director and Head of the Portfolio Specialist team at Sands Capital. And in that role, I work closely with the portfolio management teams of the global growth and emerging market growth portfolios that are on the BCI platform. And today, I'm really thankful for the opportunity to share some perspectives on the opportunity set for emerging markets and how we're navigating this landscape. So before we get into the topic, I did want to provide a brief overview of who we are at Sands Capital and what we do. So we are a privately owned specialist investment manager with a sole focus on long-only growth equity investing. We were founded in 1992, just outside of Washington, D.C., and we also have offices in London and Singapore. We ended the second quarter with $58 billion in assets under management in our various strategies. And we serve clients in roughly 40 countries around the world. And in fact, outside of the US, South Africa is actually our second largest country in terms of number of investors. And importantly, we do just one thing, and that's look for growth businesses and own them for a long period of time in concentrated portfolios. And we apply the same structure, the same approach rather, across the capital structure, whether it's venture capital or public equities, as well as around the world, whether it's US or emerging markets. And regardless of whether it's a venture capital portfolio or an emerging market portfolio, all of our strategies have very similar characteristics. The first is that our decision-making is driven by our 6 investment criteria. Anything that we own needs to be a strong fit with those criteria. All of our portfolios are concentrated in terms of the numbers of holding. They're conviction weighted, which means that the strongest fits with our criteria are the largest weights in our portfolios. They're long-term oriented with a typical investment horizon of 5 years or more, and then they're all managed by small decision-making teams. There are no star portfolio managers at Sands Capital. Now, at the firm, we seek to be business owners and not stock traders. And each of those words, business and owners, has important implications. When we think business, it means that we're focused on the earnings growth. What can support that earnings growth, bolster it, and improve it over the time? And then ownership, implicit in that, is long-termism. We are trying to benefit from the improvement and the compounding of that growth over time. And this slide here shows the decomposition of the cumulative return of our emerging markets growth portfolio disaggregated into earnings growth and valuation change. And as you can see, more than 100% of the return since our inception has been driven by earnings. Now, in any given year, as you can see on the bottom, valuation fluctuation may help or hurt. Really, over the long run, what matters for us and what matters for the results that we deliver for our clients are the compounding of the earnings growth. And that's how we orient ourselves in terms of our approach, our philosophy, and our portfolio construction. So with that brief overview aside, let's dive into today's topic in terms of what's happening in emerging markets and how we're positioning ourselves in this portfolio. So the three key takeaways from this call are that, one, emerging markets have emerged, and it's not simply a catch-up trade. And I think that that's something important and maybe different from what is getting reported in financial media, traditionally speaking. Selectivity still matters. And so despite the asset classes rise, you still do need to pick your spots in terms of where you're allocating capital. And then finally, you have to be there and not be getting there. And this is a Sands Capital-ism, but what we really mean by this is that you need to be forward-looking and positioned for where the growth may be in the future, rather than where it has been in the past. And that's especially important in the context of emerging markets, where this asset class has just seen so much evolution over the past decade. So emerging markets have been a tough conversation, especially over the past 5 years entering 2025. Traditional portfolio theory would suggest that an allocation to emerging markets would bring a growth benefit as well as a diversification benefit. And frankly, over this time period, they delivered neither, prompting many questions to ask, why bother with emerging markets? Here's a 5-year chart comparing emerging markets to the US as well as developed markets more broadly. And the net of this is that the annualized return for EM relative to those other two comparisons were paltry, with more volatility and much more downside. And so the question that investors were asking was somewhat valid just based on this result. Fast forward to 2025, though, and we have found the answer. Why bother with emerging markets? This year, it demonstrates why. And so in the first quarter, given the disruption that we saw with trade policy uncertainty, questions about artificial intelligence developments, just general economic concern, developed equities and especially US equities saw a pretty significant decline in the first quarter. But bolstering broader based portfolios was that allocation to emerging markets, which were actually positive during the first quarter. As we flipped over to the second quarter and some of that trade policy uncertainty began to dissipate, we saw a rebound and some momentum from developed parts of the world. Emerging markets actually kept pace and it continued to outperform, and they've continued to do so entering the third quarter. And so 2025 is kind of that punctuation mark on why you shouldn't give up on emerging markets just yet. Maybe there's something there. Now, another point that I would want to make just beyond the return is that diversification benefit is also beginning to come through. And so here we simply have the 1-year rolling correlation of emerging market equities and US equities. You can see that kind of over the past 5 years, it's been quite high, above average. But as we kind of zoom in on this more recent period, that diversification is coming through with such a low correlation. And so that's kind of what you would hope and what you would expect from an asset class that has such different drivers happening there. So what's the driver here? Some people would point to the fact that emerging markets have become very cheap, and maybe it was just a mean reversion. They might also point to the dollar weakness that we've seen over the course of this year. And both of those are valid and true. But what I think is the more important driver, which doesn't get enough attention, is this earnings growth that we're seeing from the emerging world. If we look over that past 5-year period of malaise in the asset class, one of the biggest drivers was the discrepancy between US earnings growth and the earnings growth delivered by EM. And there was just really no comparison. Fast forward to this year, and not only have emerging markets kind of narrowed that gap, but they had also outgrown US equities, at least for the first half of the year, in terms of the contribution to the total return. And this really matters because it suggests that this isn't just a one-off mean reversion or catch-up trade, if you will, but rather there's something more foundational and sustainable there in terms of what can underlie the return going forward for the asset class. So emerging markets have reemerged this year, but selectivity is really still warranted. And so the chart on the left demonstrates that, it's not so simple as just picking which country you think is going to grow well or have the most supportive macroeconomic backdrop, because that doesn't always equate necessarily to growth in earnings or even the return for the index in the given country. And then on the right, taking passive approaches, miss a massive part of this opportunity set, just given how diverse it is and how many opportunities there are. And so really, it's not as easy as picking countries and picking the passive index, but rather having selectivity, knowing what's happening under the hood, and making those active decisions. And that's how we manage our portfolio. This is a snapshot of the emerging markets growth portfolio today. And I would point out that it's active, it's concentrated, and it's growth oriented. And so the average weight of a company in the MSCI Emerging Markets Index is about 1%. Our average weight is more than double of that, than 2.3%. And that means that we are actively allocating capital in businesses that meet our criteria. And we want those allocations to be meaningful and not have a long tail of businesses that just simply don't matter. 30% of the portfolio is allocated to businesses that are only available to active investors. So these are off benchmark holdings, and those can be seen by the logos that are in color on this page. And that's important just because you're not going to be able to get access to that unless you employ an active approach. And then finally, our expected long-term annualized earnings growth for this portfolio, which is again what we expect to do in terms of the heavy lifting for overall return, is 24%. And that's roughly double what consensus expects for the index over the long run. A couple other things that I'd note on our portfolio is that one, we seek to invest in companies that can typically make their own weather. They're not really reliant on cyclical factors to drive growth. And so it doesn't really matter what the GDP growth of a certain country is in any given quarter. Our businesses are capitalizing on secular demand and change. And we'll get into what some of those are in the portfolio in just a minute. I would also point out, which is important in this environment, that physical goods exporters to the United States typically aren't strong fits with our criteria. Many of our businesses are capitalizing on domestic demand rather than exports to other countries. And that's important as the world potentially becomes less globalized. And as trade policy continues to be a question mark for many parts of the world. So we are very much bottom-up investors at Sands Capital. We are not thematic. But that said, there are certain secular trends that underpin the above-average growth, durability, and ultimate potential for our businesses. And on this slide, we just wanted to highlight a couple of those that are found within the portfolio. The first is this digital revolution, or just broadly speaking, digitalization. And so, really what this means is that we're investing in businesses that are not only enabling technology like artificial intelligence and the semiconductor value chain, but also digital services like e-commerce, ride sharing, and streaming entertainment. And many of these platforms are extensible into new products and services through which they can monetize their user base, and then also layer on things like advertising to create secondary and tertiary growth drivers. And often in many of these growth spaces, they're much earlier in their adoption rate relative to what we might see in the developed world. So we can apply lessons that we've learned from investing in similar types of businesses in the US and Europe to what we're seeing in emerging markets. Secondarily, energy transition is an emerging secular trend that's supporting many of the businesses in our portfolio. people may not know this, but emerging markets account for roughly 70% of the world's new renewable energy capacity. And China is a leader there, where EVs account for roughly half of all new car sales, and 2/3 of all EV sales are occurring in China. And then when we look at Latin America, kind of beyond Asia, the electricity mix there features more renewables than what you see in the OECD. And so this is a big story that's happening in emerging markets and is supporting key businesses that are operating at choke points with high market share. Financial services and digitalization and penetration is another important growth driver. And when we think of our US and globally oriented portfolios, there aren't a lot of banks or financial services companies that are strong fits with our criteria. It's kind of more of a commoditized service. But the opposite tends to be true in emerging markets. Whether there are opportunities addressing the large unbanked populations or even taking share from legacy incumbents and state-owned operators. These are companies that are addressing these markets for the first time or just doing it better, faster, in a more convenient fashion. And then finally, industry consolidation and formalization, I think, is another really important area. And this kind of sums up this saying that we like to have, which is that not all growth investing is tech. And sometimes there are really kind of boring, unexciting industries that can lead to above average earnings growth for the market share leaders. And these are companies that just tend to be doing it better, faster, cheaper in boring industries, but they're consolidating those industries. They are taking share from informal operators, whether that's biscuits in India or food retail in Poland or even jewelry in India. These are just massive industries where there's a lot of share gain potential, not only from taking share from those independent incumbents, but also just from the underlying growth in those markets. So as optimistic as we are about the asset class, the market environment and the operating environment for businesses does remain really fluid. And so whether you are an investor or running a management team, you're navigating a lot of different cross currents, whether they're geopolitical, relating to the AI adoption, economic data, what central banks are doing. And not only can these cross currents affect business results in any given quarter, but it can also affect how investors are going to react to those results and what equity premia they're actually going to be paying on different companies. And so today, we believe that our portfolio is much better positioned to kind of navigate these cross currents than it was in 2021 at the dawn of the last big market disruption we saw with the significant rise of interest rates here in the US. And so when we look at the portfolio today, not only are our companies more efficient and higher quality in our view, but the portfolio itself is far less vulnerable to external shocks when we look at the percent that's in non-profitable companies or even the overall valuation profile. So we're very confident in our portfolio's ability to not only capitalize on the earnings opportunity that is ahead of us within emerging markets, but also to mitigate some of those risks and uncertainties that we do see. So that concludes my formal remarks for today. I do want to thank you for your time and attention. And when you think of Sands Capital, hopefully you continue to think of and associate us with growth investing, earnings power, and business ownership. And from this call specifically, the key takeaways again are that emerging markets have emerged, but it's not simply a catch-up trade. Selectivity does still matter in the space, and that you have to be looking ahead. You need to actually be there and not be getting there. Thank you again, and we'll see you next time.
Right, thank you very much, Dan, for that. Online and ready to go, we are joined by Nick Dennis from Anchor Capital. Nick, how are you doing?
I'm good, thanks, Eugene. How are you?
Very well, thank you. Nick, before you start, I mean, your global equity fund is doing super well at the moment. Going into 2025, I think a lot of investors were very cautious, or maybe perhaps too cautious. Your presentation titled, "Are we taking enough risk?" I think a lot of us took too little risk, but the question now is going forward, do we take enough risk? Thank you so much for your time.
Thanks, Eugene, and hopefully I can at least partially answer that question. So today, I think I want to challenge the audience's thinking in terms of the concept of risk, and both in terms of the current market environment, and then just also from I would say from an asset allocation perspective. So the big ideas that I want to talk about today, there's a couple of points. So in my view, many investors, maybe most investors, are too risk averse, and I think there's a good host of reasons for that. I think because of this, I think the market offers some really compelling, attractive opportunities and potential rewards for investors that are prepared to take risk. So for risk takers, I think the might sound obvious, but I'm not sure it is. It's the job of your equity bucket or your equity sleeve within an asset allocation context. The job of that bucket is actually to take risk, not to minimize it. And then, yeah, fourth point, I'm really, really bullish on AI. And I know there's a lot of skepticism in the market about it. There's a lot of skepticism in the media. We've already had some massive winners in the AI space. I think it's still early days, and I think it's a generational opportunity. Okay, so what is risk? I mean, I think risk has many definitions. I'm not going to try narrow it down to one. You can define it in different ways. So one definition is volatility, and I know this will make other fund managers very angry and upset, and they'll say, no, it's only permanent loss of capital. Okay, that's fine. That's one argument, but I think I'm comfortable using volatility as one expression of risk. There's other forms of risk. So as a fund manager, or for the IFAs listening, one risk is being different, and you look different from the benchmark, from your peers, or just from conventional wisdom. And when you're different, then you also run the risk of looking stupid if your views don't come to fruition. And then that also, you'll look stupid and you'll have bad performance. So that's a risk. That also, for fund managers, for fiduciaries, for IFAs, that can bring along career risk. And arguably that is, in some ways, the biggest risk that fiduciaries run in this business. If you underperform for long enough, you lose your clients and your job. And then, typically risk has got only a bad connotation. It's only seen in a bad light. But I think if you think of a normal distribution curve, you can have the left tail, which is downside, but then you've also got the upside, which is the right tail. And then I think you get, some stocks which have this much wider range of outcomes. If you think of like an Nvidia over the past 10 years, like this massive upside, which you never ever could have predicted ahead of time, relative to something like a Coke, which has a narrower range of outcomes. And so you would say, yeah, Nvidia is quote unquote riskier than Coca-Cola. So when I think about risk, I think the law of conservation of energy comes to mind. So I've come up with my own law. It's called the Dennis law of conservation of risk. So, much like the law of energy, conservation of energy, I say risk can't be created or destroyed, can only be transformed from one form to another. So I would say, as an example, like if I don't want to take risk as a fund manager, I would just want to keep risk as low as possible. I don't want to look stupid. I don't want to take any career risk. Ultimately, someone has to bear that risk. And that risk is going to come in the form of potentially, my returns are going to be low, and that's going to impact the end client at the end of the day, and they won't meet their long-term goals. And so you absolutely don't have to take risk. You don't have to. No one's forcing you to. But there is a consequence for not taking risk. And I think in financial markets, equity markets in particular, and I think this extends to life. Like the biggest risk is actually not taking any risk or enough risk. I mean, this has been borne out by you can just see how stock markets have done over time. So why, if you look at the media, you look at commentary on Bloomberg, you see what a lot of fund managers are saying, and I'm not pointing at anyone in particular. You look at surveys, you look at positioning. People are just overwhelmingly cautious. I would say negative, pessimistic, just always. I mean, not even glass half full. Like it's more negative than that. And so, why are people so why are people kind of so risk averse? And I think we've been conditioned to be risk averse. So, if you're a fund manager or you're a CIO, somewhere between your sort of early to mid 40s through to your 60s, a lot of us cut our teeth during the global financial crisis. We were sort of analysts or fund managers at that time, and many people were deeply, deeply scarred by that event. And then you just look at the last, 5-6 years. We've had 3 pretty challenging bear markets in that period of time. So that naturally, I think there's this feeling that we're always waiting for the next shoe to drop. And you can see this in the positioning data where institutions, a lot of them unloaded risk around Liberation Day, and then have really been slow to, well, they might have unloaded risk even sort of post the election, just thinking, what is Trump going to do? And some of them further reduced risk around Liberation Day, and then have been slow to take risk back on. You can look at how boomers are positioned, like the baby boomers. A lot of them have a very, very cautious attitude about equities. You can see this in like Charles Schwab's sentiment index. And then I find this quite interesting. But this is not a lot of these are not these are general statements, not universal statements. It doesn't apply to everyone. But I find it surprising just chatting to people that are younger than me, people in their sort of even 20s and 30s are really, really risk averse. And I think they grew up post the financial crisis. And it's just surprising. You think that you're at a perfect age to take risk. Why aren't you? But they are often positioned in very, very conservative products. And so the group that's really won post-Liberation Day has been, I guess, a subset of retail traders. It's like your Robin Hood crowd. And they've done well, and they have been rewarded for stepping into the void and for taking risk. And it's because of this, I think it's because of this that people are so, so many market participants are so risk averse that I think you do get paid to take risk, obviously in a sensible way. So I think we're in a bull market. Hopefully that's obvious. Share prices are going up. Markets are at all-time highs. That's not what you see in a bear market. So I think this is an ongoing AI bull market. But I think similar principles apply to the AI bull market as any bull market. And so how do you outperform in a bull market? And the first most obvious thing is you have to take risk. You can't be in low risk instruments and hope to do well in a bull market, or you can't keep up. And so you do have to take risk. And for me, that's also like you have to be bold. And it sounds crazy for a fund manager to say that. Like you won't hear that very often. But you've got to be bold. You have to be different. And I would say you have to have a positive and optimistic view about the world, which sounds like it feels like it's insane to say that. But I mean, you just have to express a positive view on the world. You do have to be right. Like you can't just take risk. And if you take risk and you're wrong, the consequences are severe. So you need to be right. You don't need to be right all the time. You need to be right just enough of the time. So even despite this view, you have to have a strong stomach. Like we saw with this, the drawdown from Feb to April, even in the context of a secular bull market, you're going to have some bear markets and you're going to have some severe corrections. It's not one-way traffic. Like it's hard. It's meant to be hard, and you get paid for that. And then I'd say like tremendous amount of skepticism on AI. Everyone's always rolling their eyes. Always, this is a repeat of the tech bubble. It's all going to end badly. Let me offer a different perspective. I think it's okay to be an optimist. It's okay if you use AI, and the more you use it, the more useful I find it. I think it's okay to be an optimist about the world. It's okay to sort of quote unquote drink the Kool-Aid, but just, as I say, sips, not gulps. Like don't lose your mind. You stay objective, but like don't be overly cynical about this stuff. And then I'd say so I really enjoy these memes that you see on X, and it's what it shows is a normal, like a bell curve, a normal curve, normal distribution, and on the X scale is IQ points. And then you've got the kind of the sort of quote unquote dumb retail kind of trader on the left, and you've got the Jedi super trader, it's like genius guy on the right. And in the middle is the guy's sort of average intelligence, and it's like overthinking everything, like it's got 10,000 line spreadsheets. And this is the person that doesn't participate in the, in the obvious trades or the best things because he's too clever. And so, my final point is I'm allowed to kind of knock CASAs and CFAs because I've held both designations, but I can tell you that these things are not useful in bull markets. It's not your CA that's going to help you make money. So you've got to think a bit more laterally than that. And I mean, I think the best, probably just a case in point to illustrate this is the example of Palantir, which has just been an unbelievable performer over the last 5 years. And the CAs kind of all missed this one. And so did I. Like I looked at this like a traditional CA and I got it completely wrong. But the market, it doesn't work. It doesn't work how it's supposed to work in the textbooks. And so this is the lesson for the it's a lesson for bull markets. And as another lesson is there's lots of hand wringing about valuations. I can make many counter arguments, but that's not really the point. The point is you look at the blue circle on the chart. Palantir started last year at 55 times forward earnings, really expensive by anyone's measurement. And since then, to its peak, it was up 900%. So like, as a CA, CFA, like, according to the textbook, you missed that entire run. And so did I. And so, as Steve Cohen, as a legendary trader, made the point that like everyone is a calculator, math is not an edge. And I think that applies to many of the arguments surrounding sort of valuations. So onto the story about AI, bullishness on AI. I think it's early days. I think you're really seeing companies starting to implement it and starting to see the results. And there's still such a long way to go. But I think about AI in 4 primary buckets. So the first bucket is the infrastructure layer, and so it's kind of obvious. These are the semiconductors. It can be supporting industries like the infrastructure and energy, but it's companies like Nvidia that are winning in that, and that's somewhere where you can invest. The second bucket that I think of is where AI is actually driving the core of the business. If you think about it, Meta, so Facebook, Instagram, it's essentially an AI business, using AI to get the right ad in front of the right user at the right point in time. Then the biggest bucket, if you look at the bottom left, I think is really strong companies, good companies that are using AI to make themselves even stronger. And it could be often it's companies with that process a lot of transactions, got a lot of users. And then if in future and even actually today, it'll be physical AI. So Amazon is increasingly using robotics. So I think what you'll see, and you're already starting to see it, is employee count for these companies starting to flatten out, but revenues will still go up. So productivity is rising, and that's going to be brilliant for margins, and ultimately free cash flows. And then the final bucket, which I think is potentially the most interesting, is I think in this world that we're going to have just AI abundance of everything. But I think in this world, I think sort of humanity is going to become more valuable. If the internet is just sort of AI creating more AI, and everyone just does their speech on AI, and everyone uses their AI to write their emails, like to me, that doesn't appeal to me. Like I don't just want to interact with an AI. And so things that are more, I think humanity, things that are more scarce, and things that are more human become more valuable. And so I've used the example of Reddit, which is, if you've got an interest, you could be rugby or poodles or whatever, there'll be a forum or a community on Reddit that you can engage with other people that share the same interest with you. And then what's also valuable about that is if more and more of the internet is just generated by AI, human content, it actually becomes more useful to the AI. And Reddit monetizes that, but in future, they're going to be able to monetize it even more. So just to give you a quick snapshot of the Anchor Global Equity Fund. So yeah, unashamedly, I'll say, yeah, we are taking risk. Like we are expressing views. It is a and we are taking bullish views because I'm bullish. It's a concentrated portfolio, typically between 25 to 35 names. Right now we're on sort of 27 names. We take meaningful absolute and active bets, so we do take the benchmark into account. And then looking for multi-baggers, looking for companies that can go up, that can leverage AI or whatever technology or whatever trend. And you want those companies like an Nvidia or a Palantir that have the potential to go up hundreds of % if you're right. And I would say the vast majority of our holdings do sit in one of those kind of 4 AI buckets. And look, I hope it's come across clearly, but I'm the short term, who knows? Medium to long term, I'm very, very bullish on the markets, and I'm even more bullish on the opportunity set. I think it's going to be sort of fantastic, but I'm not saying there won't be kind of bear markets or steep sort of drawdowns along the way. So I'm really 100% not saying it's smooth sailing, but I think if I think of the end destination, I think it's something to look forward to. And so the fund is positioned for a bull market, but I'm not, I think I've illustrated over time that I'm not dogmatic. I can be pragmatic, and certainly, like, if I'm wrong on this stuff, then we'll reel our necks back in. So then, sort of also wanted to move forward, talk about this idea of risk more from an asset allocation perspective, and you can sort of relate that from the fund up to the kind of asset allocation level. And they use the example of Nestle, and I'm not knocking Nestle kind of in particular, but it's a proxy for kind of can be for other styles or kind of defensive, sort of very defensive stocks or low vol names. But it's the problem with something like a Nestle is, and it's also the problem with sort of shoving risk minimization throughout the asset allocation stock onto so like your cash is there to minimize risk, your bonds are there to minimize risk, you want your equity manager to minimize risk. But it's difficult for an equity within that equity sleeve to do that. So like Nestle should be defensive, but it's fallen in the bull market and it still gets hit in the bear market. So literally, what is the point? So I would argue that, if you can, from an asset allocation perspective, rather hold like more, say, in Nvidia, and then hold more kind of uncorrelated assets, so that you can hold more Nvidia as a joke, as an example. So this is moving on, like, so I think this is a sort of a bell curve, kind of a bell curve, showing sort of, this is just a hypothetical. So it's the forecast returns for the Nasdaq over the next, say, 5 years. On the left-hand side in the red circle is like, okay, could be a bad drawdown. But then on the right-hand side in the green oval is like, that is you could have really, really high returns, potentially. And so my perspective, just listening to people, is everyone is super, super focused on this, terrified of the left-hand tail. And they just don't think about the right tail at all. And I think it's really, really worth thinking about, both sort of at the mandate level and my level, but then particularly also at the asset allocation level. And so I came across the saying recently, which is, the better the brakes, the faster you can drive. So it's like a Formula One car. And I think, back to my previous point, is that your equities are there. You are there to take risk, and those are the accelerator. And what allows you to press a foot in the accelerator is having really good brakes. And in this case, the brakes are your uncorrelated assets, your hedges, could be gold, bonds, CTAs, volatility products, or whatever. But the point is that the better your job you can do on the uncorrelated assets, on the brakes, that allows you to take more risk on the equity sleeve, and that's exactly what it's there to do. So rather than just driving slowly to your destination at a snail's pace, like, structure get the overall asset allocation right, and then you can actually travel quicker to that destination. And with that, I mean, that is all I have to say. So thank you, Eugene, for the opportunity.
Nick, thought-provoking indeed, and I think a lot of us that's got FOMO took a lot out of your presentation, and you're obviously driving it automatically because there's no clutch. Just one question very quickly, and it speaks to how tall can trees go. When you decide to close out on a company or exposure in a company, When is enough enough?
Yeah, so look, I think my bigger mistake has been selling too early, rather than selling too late. So I would say, and the hard thing is that valuation is typically not a guide. And often I think the stock itself will give you clues. So for example, you'll see like maybe the company will report, and I saw this in 2021. Well, a company will report blockbuster numbers, but when the stocks stop going up on blockbuster numbers, that's a first warning sign. Because typically the market will preempt the downturn in the results. So that the stock will start falling before the results turn. So so it's not easy, but like I think the bigger risk is selling too early than selling too late. And you've just got to stay on top of it and top of the story, listen to the tea leaves in terms of what the actual stock is telling you. And look, as long as it all sort of checks out, and I think it still does for AI, like don't be too quick to sell.
Very interesting, and it worked for your fund, and you've run a worldwide flex fund as well. I think it also did extremely well because of your global carve out. Good work you've been doing at Anchor Capital, and thank you so much for joining us this morning.
Thanks, Eugene.
Fantastic. Right, for our last session this morning, and we've kept this man waiting for a while, and I do apologize in advance. One who needs very little introduction from Fundsmith, Greville Ward. Good morning, Greville. How are you?
Very well, Eugene, thank you. I am, it's a pleasure to be here. I'm actually in the US, and I realized I made a huge mistake because a couple of speakers ago, you had another speaker from the US who just sent you a video, and I'm foolish enough to get out of bed in the middle of the night to speak to your conference, so I'll never do that again.
And we kept you waiting, Greville. I'm immensely grateful, and it was a pleasure to have you on our session, so thank you so much.
Not at all. Pleasure. So, hello, everybody. Thank you very much for waiting this long. Those that have and those that haven't, you're going to miss nothing. Can we just move on to the next slide, please? There we go. And we'll move on once again. Thank you. So I think in any brief talk, you're allowed one and one only Warren Buffett quote. And this is one that I found recently, although it is from 1996. And I apologize for reading it, but I think it's really important. And he says, your goal as an investor should simply be to purchase at a rational price, a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will only find a few companies that meet these standards. So when you see one that qualifies, you should buy a meaningful amount of stock. You must resist the temptation to stray from your guidelines. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will your portfolio's market value. And I could just stop there because that is really exactly what we think investors should be doing. It's what we've been trying to do since we started Fundsmith. And one point that he makes there is that these companies are hard to find. And I think it's worth just reflecting that when we started Fundsmith in 2010, we'd only found 53 companies in the world that we thought were investable. And that has grown now. So we have an investable universe today of 93 companies. So we've added 40 companies in 15 years, so 2 or 3 a year. But I think it is fair to say that often the best companies are private, not public. Because if you're private and you're generating lots of cash and you're reinvesting the money, you don't need to come to the stock market. So finding companies that do what he says we should be looking for in the public markets is not all that easy, but it's not impossible either. Okay, let's move on. If we can, to the next slide. There we go. So for people who do what we do, sort of buy and hold high quality investing, there are a few things that have been making life a bit difficult for us in the last few years. So let's just talk about those for a moment. Firstly, in a higher interest rate environment, we own essentially long tail assets. And so higher interest rates are not particularly good for the sorts of things that we own or the valuation of the sorts of things that we own. I think the higher interest rate environment is interesting also because if we reflect back to the beginning of this year, everybody was predicting that by this time we would have had at least 2 interest rate cuts, and obviously so far we've had none. So we've had a higher interest rate environment for longer. and this is a slight digression, but I think it's an important point that I read last week a description of the US economy, which is that a third of the US economy is doing very well, a third of it is kind of teetering on the brink, and a third of it is doing really poorly. And you'll see that in reporting from things like the dollar stores and so on, that people who are not making much money are spending less on groceries, which is a slightly worrying trend. So I mentioned that only in the context of the fact that the market seems to be blissfully ignoring the fact that interest rates have been higher for significantly longer than we had been predicting. And Chairman Powell is in a difficult position because although Trump is very keen for lower interest rates, the economy doesn't at the moment necessarily lend itself to aggressively cutting interest rates, because if he did, he would create inflation, which nobody wants. So anyway, that's point one. Point two is more than 50% of the stock market is now so-called passives. Although we try and remind people that investing passively is actually a momentum strategy, and there's a sort of wall of money going into passive investments. You may have read recently in the last few days that the number of ETFs has outpaced the number of individual stocks in the US stock market, which is pretty extraordinary. Not all ETFs are indexes. Some of them are aggressively levered individual stock plays, but it's still interesting that more than 50% of the market is invested with no regard to either quality or valuation. That is a change. As Terry, who runs Fundsmith, said recently publicly, in an environment where there's this huge move to passives, you kind of want to be the last active manager left, if possible, or the last active manager alive, because it must throw up opportunities. If the world doesn't care about valuation or quality, then you must get some anomalies that you as an active manager can capitalize on. There's obviously a flow from active to passive, and that in itself creates momentum, because every time somebody takes the money out of an active fund and puts it in an S&P tracker, then that ETF or tracker has to go and buy shares in the biggest companies in the index. And that has been going on for a while. It may go on for a while, but that flow is almost creating its own momentum, if you like. There are also active funds that own shares in the biggest companies in the index in order to save their jobs. See the previous speaker for details, and they are effectively passive as well. So the amount that is invested passively is significantly higher than the amount that's invested actively. And lastly, the algorithmic traders are exacerbating this move, because what happens when you start to get a flow of money into a particular stock name, the algorithmic traders are trying to jump in front of that to make a very small return many times a day, if you like. And all of that does is just exacerbate the price movement. So anyway, that's the environment we had for the last few years. Who knows how long it's going to continue, but it's not ideal for the long-term sort of quality investment approach that we have. Let's just move on, please. This is just a chart that shows the inflection point a little while ago when passives went sort of through the active line, if you like, and have continued to move up since then. But as mentioned before, it's not really a passive strategy, it's a momentum strategy, which works fine for as long as it works. And then when it doesn't, it's a question of how much stomach retail investors have for a different outcome or for losses. And if they start selling their passive strategies, then clearly there's going to be a momentum trade the other way. Okay, let's move on, please. So this is just another thing that has had an effect for those of you that are invested in our fund in sterling. The US dollar has clearly weakened in the last little while, leaving a sort of dilemma for Trump. It's not really a dilemma, but he wants interest rates to come down. He wants them to come down fairly aggressively, but he also says that he would like the dollar to strengthen, and those two things don't usually go together. Given that everything Trump does is somewhat unusual, maybe he can make it happen. But the move from the sterling dollar, I mean, you'll remember through the Brexit period that sterling to the dollar moved from 155, 160 or so down to about 120, and it's now bounced back up to 135 or so. But for those invested in the sterling class of our fund, that has been adversely affected by the fact that 74% of the fund is invested in US dollar listed stocks. The dollar share classes of our funds have done quite a bit better this year than the sterling classes because of that currency move and because of the dollar weakening. If we move on, please. So stock concentration, I mean, people have talked about this quite a lot, but this has happened fairly quickly. The largest 10 stocks now representing 35% of the index, the largest 3 stocks representing 18% of the index. I thought it might be interesting just to read you, if you will indulge me, the largest 10 stocks by capitalization in the US market in 2000 in order were General Electric, Intel, Cisco, Microsoft, Exxon, Pfizer, Citigroup, Walmart, Oracle, IBM. In 2010, they were Exxon, Apple, Microsoft, Berkshire Hathaway, Walmart, Procter & Gamble, General Electric, IBM, Johnson & Johnson, AT&T. 2020, they were Apple, Amazon, Microsoft, Alphabet, Meta, Berkshire Hathaway, Visa, Johnson & Johnson, Walmart, Tesla, and obviously the largest stock at the moment is Nvidia. So this is an unusual market where a very small number of stocks, call it 7 or call it 10, have been dragging the market up over the last few years. Will that persist? Sort of nobody knows, but given past history, it seems likely that it seems quite likely the names will change, that the 7 that are leading the market up and have been leading the market up for the last couple of years, possibly unlikely to be the 7 that lead it up for the next 5 or 10 years. If we can just go on another slide, please. All this shows is that the largest 10 stocks equate for 34% of the S&P, but gave you 63% of the performance last year. A little bit less in 2023, but in 2022, again, only 33% of the index gave you 63% of the return. There was an article in the Financial Times this week entitled something like "The Forgotten 493" about all of the other stocks in the S&P index, which literally had been forgotten. So, I mean, it's an unusual market because of this move to passive and also because 7 stocks have basically been dragging the index up. And is that going to continue forever? Who knows? But it's an unusual environment, one that we have been putting up with for the last few years, but we haven't seen for a while before that. Let's move on, please. So just to remind people that the Fundsmith Equity Fund only invests in good companies, as Warren Buffett says. There aren't all that many of those to find. And probably worth just reflecting on the fact that we can only find these companies in really 3 sectors: healthcare, old line technology, and consumer, because all of those industries can make money irrespective of what's going on in the global economy, because you're still buying toothpaste and dog food, and you're still logging in to look at Instagram, and when you fall off your motorbike, you're being put back together. So those sectors are where we can find these companies. There are many sectors where we can't find these companies, notably banks, insurance companies, mining, oil, most big pharma, biotech, chemicals, steel, utilities, telcos, real estate. None of those can we find companies that you can buy and just hang on to for a long time. The second point is don't overpay. We try and buy them at the right company. And then we do the hardest thing of all, which is nothing. I just wanted to sort of reflect on that. I think some people are slightly confused about the do nothing bit of our strategy, where they think we literally do nothing and we sit and put our feet on the desk. But that is not true. The do nothing bit is the analysts at Fundsmith. It's a very written-based research culture, and the analysts at Fundsmith spend all of their time writing on the 93 companies in our investable universe. We follow all of those as if we own them, and whatever those companies are saying or doing on any given day, all of that is being written up. Discussions with the management of the companies are being written up, meetings, conferences that they attend, which means we just have this absolutely gigantic sort of research database of those 93 companies, of which we own 27 in the portfolio at the moment. So that's our definition of do nothing, although we do swap out 2 or 3 stocks a year. If we go on, please. I was doing a presentation in the US a few years ago, and the chat I was seeing, the institution I was seeing, said you should throw all the other slides in the presentation away and just put this one up because it's the only one that matters. And there's some truth to that. But we believe, as does Buffett actually, that return on capital employed is the most important measure of whether companies are doing a good job or not. We need our companies to make a return on capital significantly above their cost of capital. And you'll see there that on average, the companies in the fund today have 32% average return on capital. That is the highest it's ever been, actually, since we started the fund, but it's also twice the S&P. So when we say we own better companies in the market, I think we can justify that by saying our companies have significantly higher returns. They also have very high gross margins of 64% or so, which is unusual because the average start date of the companies we own today is 1922. And so they must be doing something to create a significant moat or reason why others can't compete with them and can't compete away that margin. So we like the fact that it points to the fact that they're hard to compete with, a margin which is that high. B, if you have margins that high, you can absorb problems or higher input prices or higher interest rates or logistics sort of breakdowns or higher logistics costs. You can absorb that and still make a very healthy return. And so for us, high gross margins point to a very powerful business that has some kind of a moat, but also has the ability to absorb tariffs, for example, and not necessarily pass them all onto the consumer while still making a very healthy return. And the only thing that we say to people about the 27 companies that we own in the portfolio is they're bigger today than they were yesterday. They will all be bigger again tomorrow. We have no idea what the share prices are going to do in the short or medium term, but we know all the 27 businesses are bigger than they were yesterday, and they will all be a bit bigger tomorrow. If we could move on, please. So in terms of valuation, just to say that this is calculated as at the end of last year, so it's a fraction out of date. We think the valuation is actually, the free cash flow yield is probably a tiny bit higher than the 3.1. It's probably close to 3.4. The S&P non-financial is 3.7. So our portfolio is trading on a valuation which is pretty close to the S&P, but as in the previous slide, I hope that we all agree that we own better companies than the market. And you'll see below that the free cash flow yield, sorry, beg your pardon, the free cash flow growth last year was 14%. Again, that's as high as it's ever been since we started the fund in 2010. That is possibly helped a little bit by the still sort of post-COVID getting back to normal. The long-term average free cash flow growth is sort of 9 to 10%, and we're very happy that our companies can go on producing that on a free cash flow yield of about 3.1 or 3.4, something like that. Two more slides. Can we have the next one, please? I'm just going to show you, I mentioned before that there are a few sectors that we invest in, a lot that we don't, but that just shows you the sort of technology, consumer, and healthcare are the three main areas. I will say that when we started the fund 15 years ago, we had more in the consumer area. We did own stocks like Nestle, which was previously mentioned, and we used to own Kimberly-Clark and Reckitt Benckiser and some Pepsi and some other things we don't own today. But that area, the consumer area, has struggled to grow over the last few years in certain sectors. There are bits of it which are growing, so we still own Procter & Gamble and Church & Dwight, but there are bits of the consumer, particularly the center of the supermarket, food companies making bread and cereal and other vaguely unhealthy things, Campbell's Soup and so on, which are struggling to grow. And so we have fairly significantly reduced our consumer weighting in favor of more healthcare and more kind of technology broadly based. And the last slide, if you could put that up, is a geographical split. And here, as mentioned before, we do have 74% in the US. This is, again, sometimes misunderstood as us taking a big bet on the US. That's not true, because everything we do is bottom up. It just happens that if you're looking for the biggest and best companies in the world in consumer, healthcare, and technology, they happen to be listed in the US. They're doing business all over the world. And as you can see on the right-hand side, by revenue, less than half, 50% of the turnover of the companies that we own today is in the US. A third of it or so is in emerging markets, which is what you want if you own consumer companies, because that's where the populations are growing. There's no population growth in the developed world. But the US exposure helped us a lot, has helped us a lot over the years. It hasn't helped us particularly for the sterling-based investors in the last year or two. But as I say, if you want the biggest and the best technology, consumer, and healthcare companies, they just happen to be listed in the US, even though they're doing business everywhere. That is it, Eugene. I've got nothing else useful to say. I can let your poor people go away and have lunch now.
I'm gonna stop you very quickly, Greville. Just two quick questions.
Yeah.
Sector exposure. I know it's a question you get very frequently as well. Are you venturing into defense sector? I mean, even if Trump stopped all the wars in the world, everybody is allocating more funds to defense.
Yes.
Are you looking at some of those companies?
It's a good question, and one that we have been asked a lot recently, because there is a lot of war in the world. The answer is we did a huge report on it. We went away, one of the analysts went away and spent quite a long time writing a huge report on the sector and on the companies within it. And we just couldn't find a company that we could get comfortable buying. And the reason is that most of the contracts are government contracts. And the problem with that is that you can't have a huge government contract and then dance around the maypole and say we're making 50% margins on this contract, because the government will sack you if you do that. So most of the projects are cost plus, and they mostly have cost overruns. And there's a huge amount of risk that if you are building submarines for the government and you make a huge mess of that, they're not going to buy F-16s from you or whatever. And so we tried really hard to find a defense company that fit our criteria of quality that we were happy to own for the next 10 or 20 years, and we couldn't do it. So I'm afraid I don't think we are going to be investing in that sector.
Very last one on, you also showed, I mean, the earnings from a lot of those companies ex-US. Does a structurally weaker dollar benefit, or is it a tailwind for some of those companies? Because, I mean, you can export whatever you export, foods and goods and services, a lot more.
Yes. I mean, I think we feel that sort of net, it doesn't have a huge effect because it's really a translation effect in the end. I mean, most of the companies that, well, healthcare and consumer companies are manufacturing locally and selling locally. They're not really shipping things around the world. I mean, we own LVMH, and sure, they're shipping handbags from Italy and France, but most of the companies that we own are manufacturing locally, selling locally, and then there may be a translation effect when the treasurer announces the profits in US dollars. But in terms of sort of underlying growth of the companies that we own, I think currency moves has very little effect.
And I mean, on the feeder fund, we invest in your sterling fund as well. So we did feel some of that, but I mean, we are back to more or less normal, whatever normal is. Greville, thank you so much for your time. Wish you a very peaceful and restful evening ahead.
And next time you might get a video from me.
No, people buy people. It's always great to have you on board. Thank you so much. To our audience, thank you so much for joining us and your patience sticking around a little bit longer. Quick reminder, our third session will be next week, Wednesday, the 3rd of September, where we continue our conversation with some of the top global managers in the country. To all our presenters today, you've done a terrific job again. Thank you so much for your time, and especially for those who stayed up extremely late enjoying this session, and the guys in London that joined us very early as well. We in deep appreciation for all your time. The BCI team, thank you for setting this up, and Dan from Excel Academy for running all this, and your gift. I see there's a big take up on the AI session that you're hosting next week. I think that's going to be very, very insightful. Excited about that. So thank you for that again, Dan.